kiss it better, baby. Good morning, folks. How are you? Just doing an audio check real quick. Make sure Patrick's logged in so you can see what's going on today. Trendline breakouts and bull flags, he says. Oh, you better get ready for this one. Oh, oh, man. I slept so good last night. I slept so good. All right, so it is 25 minutes after 9 in the east coast of North America. Is your friendly neighborhood ICT, the ghost with the most. So we're looking at something of a gap that might be helpful for us today. All right, so we have previous settlement at 568 3/4 or thereabouts. So what is that? 68, yeah, 68.50. So let's get in here and mark that up. Get ourselves ready. Got a lot of lipstick on this pig. Look at this. Alrighty. We have that price right there. That's previous settlement. So that's opening range, gap, settlement. Okay. And usually I'll have this set up like this well in advance. But today I was doing some trades and sharing with my private group and then uploading the executions on the YouTube channel, which are not market replay. All you gotta do is look in the upper left hand corner. Market replay doesn't do that. All right, so let's see. I want to do that, but you're not doing it live. You're not letting me copy you, ICT. I'll do it nice and bold, and then here, middle, right. All right, and then what I'll do is I will get this in the general proximity of where prices in electronic trading hours. And then it'll be there for me when I need to grab it. So when 9:30 opens, in just a few minutes, 2.5 minutes, I'll just drag this chances are we'll be where we're at here under that previous settlement. So this will be opening gap range low. Okay. So I'm moving it away from price. That way you're not confused. It's just a way for me to stay ready to plot it on the chart, and there it is. So this is previous settlement price way up here inside the new day opening gap of August 16th. Notice that? It's like inside that little gap. So there. That's the low, that's the high, that new day opening gap. And then the opening range, previous day settlement prices in there. So this would be a very nice gap if we can stay real close to where we are here. Be nice, very, very deep discounted opening range gap. And you're probably going to hear my wife. And no, I'm not going to go into another area of the house because I have to be comfortable while I'm doing this. It's about me, okay? It's all about me. You're just eavesdropping on a conversation I'm having with the son. Too many people in the comment section are really entitlement-minded. I want you to do it like this, or if you don't do it like that, yeah, go watch somebody else. So that's all the people out there to watch. All right, just another 45 seconds or thereabout, and we'll have the opening bell. I'll cover the trades I took this morning. Why are you trading pre-session? I thought you said pre-session is 7 o'clock. No, pre-session is anything before the opening bell. But you can set up operating hours as early as 7 o'clock and work between 7 o'clock and 9:30, or 10 o'clock, something to that effect. All right, so we're getting real close to it, Mildred. I've noticed since I started live streaming, and I'm telling you what levels to watch, they're running into the opening range gap a lot faster because they know I'm trying to teach all of you to fleece. It's okay. You'll be able to do it for the rest of your life. You ain't got nothing to worry about. Okay, and then obviously this segment now is opening range gap high. All right, so we have a discount opening range gap. You can see it right here. So we opened here all the way up to here. So now that's the business. So we can go over to electronic trading hours now. This is the gap, and you can do the quadrant levels on it. Stupid ad from Obama. We have $100 million, but we need more money. Yeah, somebody's getting paid. So this line right here, that is the midpoint of the opening range gap. Okay, so it's consequent encroachment, and we are always watching to see if it wants to retrade to that inside of the opening range. Okay, opening range is 9:30 to 10 o'clock. It is not 15 minutes. It's a 30-minute interval. There you go. 70% of the time, it will trade up and touch that mid gap. It matters not for a bias. You don't need a bias. You don't need to have the daily range bias. You don't need to have the session bias. Okay. Right now, you're just studying how price is delivered. I guess it should be done like this. There you go. This should be on the opening price, right? Not there, Michael, come on. Act like it's your first day doing this. $9.30 opening price right there. Okay, so that was, we have everything outlined technically, and you can see that that level here is the mid gap or consequent encroachment. So far, a little unorganized in the opening session. Nothing terribly exciting yet. No initial fair value gap formed. Just want to take a peek. We do have minor sell side here initially. So when it's like this without a fair value gap, it can drop down, clear the sell side, and then return back up and hit the mid gap. That's usually a nice little dandy of a profile to study. So that's always in the forefront of our mind when we're watching scenarios like this. Doesn't necessarily mean you got to take a trade, but for the purposes of like Caleb, we can watch and anticipate, study, and see what it does. The main thing is just, Caleb, you're building your experience watching price action. Okay. The first order of business is always determine if there's a gap. We have a significant gap. It means it's more than 20 or 30 handles. And mid gap is always our first threshold. Do we want to trade there? Does it do it in the first 30 minutes? And it's 70% likelihood that it does that. Okay, and you can make it exciting by putting an alert. So if it hits that and crosses over by one tick, it gives you like that little excitement, like that's an alarm bell, like, yay, get away from me. Go ahead and say something. They'll hear you. My wife's. Go ahead and say something. They've heard you in the background before. Get out of here. Come on, I'm trying to do something. Yes, I'm live. I'm not recording. It's live. Oh, now it's a different story, right? Anyway, we had the lower quadrant traded to, and we can see that here. So lower quadrant here, and that's another the roll to the sell side, and then maybe come back to a half closure on the gap, or maybe dig in a little bit deeper. I'm not trying to have a bias so far. I'm going to just sit still and relax and take it as it comes. If you look at the ES, that's even uglier. See that? So it swept its minor sell side liquidity in here. But in Q, I prefer those down there. So we'll be watching that and see what we get. So the only gap it's used so far for NQ is this one right in here. And that's outside of the opening range. So 9:30 to 10 o'clock, we're not so concerned about that. Opening range gap, extend that over. I would like to see it tap that one more time at least, like maybe one of these candles hitting it. That would have been better. We can still do it in here. So you would have this. Bottom left. Let me get a little bit bigger. So far, no fair value gap formed on your 1 minute chart from 9:30 to 10. I did an execution on ES because I have a few students, and one of the ladies that is pretty active in leaving me comments and feedback, she asked if I could bring in the ES. So I just threw that one in there today just to spice things up. Now watch that gap here that it used initially there. We went through it. See if it acts as inversion in here to send us into the sell side. Be mindful also that the economic calendar today, we have consumer confidence, or off the top of my head, I think that's what it is, at 10 o'clock. So we'll be, there you go, look at that. I'm going to screenshot that. So the setup was here. It's a very small scalp, but it's still, these things, they build your confidence. It allows you to see things. Not everything that you're studying in price action real time is an executable trade initially. You have to build some kind of rapport with price, building this kind of like this bridge of communication where you're not just blindly staring at charts and thinking, okay, well, I don't know what I'm looking for. I'll just wait for it to start moving and chase it because it's momentum. You know, that's what cows do and sheep do. Livestock do that. You know, when the husbandman, the person that is raising that animal, and they have lots of them, you know, it's time to feed them. They call for them, and as soon as the first one starts running, they all, oh, it must be the time to eat. That's herd mentality. That's what retail traders do. Okay, and retail traders are momentum style, breakout style type traders. And while that is profitable, it could happen for you. it doesn't make any sense to me to do that. It makes better sense if you know that it's likely to have a run, do the due diligence to determine where the market's going to run to, right? And then try to position yourself opposing that initial run lower. You want to be looking for things to get in going lower. And that would look something like this. Okay, so do we cross over this gap once we went through it? Yes. So these are the first elements to understanding how the fair value gaps can invert, and they change their state. Well, it was used there as support. Discount rally took about the relative equal highs in here, and any buy side was resting in here. The bodies go just a little bit above, send us lower. That gap, it's not inside the 9:30 to 10 o'clock opening range. So I'm just counseling you, Caleb, to look at what it's using while it's forming its first 30-minute range. But when it became apparent that it trades below it here, real time, watch this now, it acts as an inversion. So if you're using that consequent encroachment or midpoint of that area here to the low of that gap, which is that candle's high, and you're framing that as a paper trade, or if you're tape reading it, you're not even pushing a button yet, you're watching how it refers to the easiest low-hanging fruit objective to use for price would be the high of that candle. If you look at it up here, upper left-hand corner, it's 19,493 even. So from 493 even to running the low out here, it's 76. So it's going to go below 76. How far can it go below 76? And you go back to the left side, look for any inefficiency, any singular low or relative equal low for actual pending orders that would be in the marketplace in the form of sell stops. But I taught you, when you're using ranges like this, a quick down and dirty way of doing it would be to do a quadrant for the range you're working within. So there it is. So here's your range from low to high. Real quick, easy target shooting. There's your objective, and it goes down just a little bit below it, but it's fine. And if you're looking for something that repeats, watching price initially, if you have no fair value gap formed thus far, this is the one that could have formed. And right now in 9:30 to 10, this is your first presentation right there. So you want to have that noted, but it wasn't giving us anything yet. So my attention had been placed there. You were all watching it. It trades from here. If you go from the 493 even as your hypothetical tape reading or hypothetical demo entry, or if that's your actual trade entry, you would have 493, where's it at? 493 high on that candle, which is the easiest one to reach to once below it. So it trades up into that. And then below this low, one tick below that, that could be a partial. And then you do your one quadrant extension of the range, and that would give you 460 and a quarter. So what's that, about 30 plus handles? That's pretty good. That's better than the average YouTuber. So, and I'm not trying to be derogatory when I say that. I'm just stating that the folks that you're probably used to seeing take trades, that's well within the realm of reasonable. It's beyond the scope of what their steady diet is. I'm convinced that they're studying my stuff now because they're starting to get a little bit longer runs, which is what I want them to do. I want everybody out there. You don't have to love me. You don't have to even co-sign and say I'm using ICT stuff. I can tell you're using my stuff. Other people can tell it too. I'll never troll you. But all I want to do is see you guys do better. And guys doesn't necessarily mean male. The females too. All right, so we have that gap right here. I get to annotate that. So you have to be mindful of this one. And you want to extend that out in perpetuity throughout the day. And we'll keep it gray man style. All right, And that's the business for today. And then we'll just sit and observe what we got so far here. So we had we had lower quadrant on opening range gap here. So between this level here, which is the middle of that opening range, the difference between where we stopped trading yesterday at 4:14 p.m. to where we open at 9:30 today, Eastern Standard Time. That gives us our gap, and you want to put your quadrants on it. You went to the lower quadrant. Could it trade to the midpoint? No. So far we have initial heaviness, and we want to really pay attention on how we trade here after breaking through this sell side. If we start to climb back up, midpoint is still a measurement. As long as it doesn't come back up here, this is going to stay heavy all day. This is actually on the wrong spot. I apologize if it's confused you. Trying to talk about this stuff and draw all this stuff on my chart when it's not necessarily there for me, it's a little cumbersome for me. So there is your 930. The opening tick is where it's at. So that is the opening range gap low. So if you've been looking at that, you're wondering, like, what is that? It doesn't make any sense. It's because I'm trying to outline everything, also reading it over a 1 minute chart. And it's a lot to do. It's a lot of plates spinning right now. So the same logic. All right, so we had one more reach down below short-term low. In time frame. Okay, so we have this low here. So last Friday's 8:30 low. See how clean that is? Right here. I believe that might be something that we could be using soon. I'm not going so far to say it's for today, but that is something that my eye is really drawn to when we drop into this time frame. So it's like it snaps right to that. So just be mindful that we could visit the 19,105 area or thereabouts. Go on the 5 minute chart. Okay. And we don't need this one. I like that. Gives a little bit of animation. Now, this can reverse its role again. Should we get back above it? It could go right back into what it initially started as. Something to look at as a discount when it was here. Hit it, rallied higher, went through it, inversion, break lower, it trades back above it. Remember, this is first presentation here. This fair value gap is the first one inside of 9:30 to 10 o'clock. Okay, so we are inside the first fair value gap of the day. Still inside opening range. Half of the opening range gap still yet to be traded to. I have a lot of new students there leaving comments. Why do you show examples in demo? Or why am I only showing examples in paper trading? I don't always show just in paper trading. I don't always show just demo trading. I have examples of trades where I've used a live broker with real money that's not demo, it's not paper trading. But because you're probably new, and you probably never heard me say this, and because you're asking brand new, which video should I watch? That means you probably didn't hear me say what I'm about to say here, but other people know about it. In the United States, there's a governing body called the CFTC, Commodity Futures Trading Commission, and they are kind of like the police of the financial markets for futures and Forex. And I am not a licensed trade advisor or a financial advisor, so to protect myself and you as the viewer, I teach in the medium of paper trading or demo trading. But when I want to show, and have shown with real money, real live account, you can look at it in the lower left-hand corner. It'll say AMP, or you can go look at the TD Ameritrade playlist where I literally logged in and showed 3 months of every fluctuation in price. But it's for my protection. I don't want to get in trouble financially or with the legal watchdogs like CFTC, NFA. And the people that are new to this stuff are just dumb as rocks. They don't get it. Like everybody I hear that's pretending that they're educating people and not really putting the disclaimers up and reminding folks that it's for informational purposes only. They're really putting themselves in jeopardy of being tapped by one of these bodies, which are essential. Now we're touching. We went above the initial fair value gap here, came down, just hit it. So I would like to see, do we have the ability to run back into the gap here? Buy side is here, and then the 70% likelihood of hitting that midpoint gap could come to fruition before 10 o'clock. But it's to, like, I don't need you if you're brand new or if you're just hanging around or whatever. I still get 1 or 2 comments. Oh, it's just paper trading. Oh, it's just demo. So I want to see you come out here with a demo account and call every little tick and trade them with a very small stop loss and show beforehand, explain it. This is what it's going to do and why. And it nullifies, it cancels out your argument. Because if I can't do it in this, where it protects me to teach the concepts broadly, and it's not deemed as financial advice, I'm not giving you trade signals. I'm not putting you into a trade where if you use real money trying to copy me, and if you lose, you could, if I was pretending to be a financial advisor and I'm saying I'm doing this with my real money right now, I'm enticing you to do something and acting as a financial advisor when I'm not licensed to do so. If I did that, that's the reason why I don't do these things. I'm not, look, I like teaching, but I'm not trying to have things put against me because people are irresponsible. So I'm the one being responsible in our relationship. So see the reaction off of that initial fair value gap. So this is first presentation. We opened. I told you when we go back above it, watch this here. It hits it, bang, run to short-term buy side. 70% of the gap. Just fell short of it. I think she'll hit it. You think she'll hit it? Why do I take trades before I live stream? Because some of you think I don't know how to trade, and I like to do this. And yeah, Patrick, full flag required, no trend line breakouts. Back into new day opening gap on the 27th, and then opening range gap high, which is previous day's settlement at 4:14 p.m. That would be a full gap closure. So far we had 3/4 of the gap closed. The remaining portion is there. Okay. So 70%, easy for me to say. 70% of the time, between 9:30 and 10 o'clock, whenever you have your opening range gap and it's more than 30 handles, you have all the things, on the checklist. Okay, it's likely to do what? Draw into that gap. How much? Half of it, minimum. You got 70% chance that's going to happen. Now let's roll back for a moment. If you are expecting that as your model, okay, say you were heavily bearish. Maybe you were fading me and you were trying to say that it was going to use this as a sell-off, okay, or you were going short on something else, and it was running up. I said if we get above here, watch and see if we get above this initial fair value gap. Then we had it go above it, closed above it. We opened, traded down, hit it perfectly to the tick, and then starts running where? To the short-term buy side. Why? Because we've upset the sell side down here. So where the waters were smooth, there was disturbance. Okay, so the predators, the sharks, if you will, they ate. Okay, they took their pound of flesh. So now where they're going to cruise to? Where it's smooth. Where is it smooth? You see these candles over here? See how smooth that is? And then right over here, all of that is too smooth when you have a full gap closure. Looks like the to the buy side there, and then we had half of the gap still undelivered. We hit it and then expanded up into 3/4 of the gap between this big broad black line and this black line here. So we have the market using that first fair value gap as your full gap closure. So you can use this as a study, much like we just did over here, from here to the one quadrant of the range from here to here. So you see me trade both long and short in the same day. And I'm giving you a very elementary way of starting how to see it and watching it over real-time price action, giving you the things to look for. You're not trying to pick every entry point. But while you're watching price, what constitutes a setup? What constitutes a valid run from a particular level that can be predicted? And to the young man that's made a video, I refute ICT's claim that there's an algorithm delivering price. Well, look, you're telling me buying selling pressure or your garbage is what causes these moves? Like if it wasn't an algorithm and I didn't know what that algorithm's doing, I could not have the confidence and the track record of sitting out here in front of everybody live over the lowest latency and the lowest time frame, which, by the way, for the folks who are asking all the time, I want to know what time frame you're using. That right there tells you it's a 1 minute chart. Okay. So if it's a 5, it's 5 minutes. If it's 15, it's 15 minutes. If it's 60, it's 1 hour chart. So you would look at this and study this with, in my opinion, it should fascinate you, because let's just say for a second that you're going to argue the case that there is no algorithm, and you're tolerating me when I say it because you don't want to subscribe to that. You believe something else. Your brother's cousin's, sister's boyfriend is a guy on Wall Street, and he's claiming that this guy on the internet is talking to you, telling you every little fluctuation and tick in the marketplace, every single time frame, literally executing on it, literally executing on live data feed, not market replay. Okay, easy to do in market replay, the guy says in my comment section. We're going to prove that wasn't market replay today, but you can't escape it. Okay, you cannot escape it. It is algorithmic. It's 100% controlled. And if you try to argue that, the only thing you're succeeding is you're saying to yourself and to everyone that you can be heard, that can hear you, that you are a nincompoop. Like you are such a moron to sit out here and say that it's buying and selling pressure, because buying and selling pressure is based on randomness. That is randomness. But if I have a direction and I tell everybody, look, we're all going to a destination, okay? Follow me, I promise you, it's going to be exciting. Not everybody's going to follow me. Not everybody's going to follow me, but some individuals will start out following me, okay? And they'll think, oh, he's probably going to this destination. He's probably going to this point of interest in the town, okay? Some local hotspot. Now, I haven't disclosed what that is yet. I just said, it's going to be exciting, follow me. That's essentially what price is doing every single day, every given moment. And traders make a decision to follow price attentively, and some of them try to stay right behind price and they chase it. That's momentum trading, breakout trading. But then you have the others that say, you know what, I don't know what's going on here, and I'm not interested in this. Somebody else is doing something else, and they claim that it's going to be a better thing going the other direction. So Kanye's going downtown, I want to go down there. And this guy over here, he wants to watch Celine Dion. Okay, who knows? Okay, whatever the initial draw is, okay, you think it is. That's the same thing as saying you believe price is going to go to this level above or this level below. Now, if I am trying to get as many people involved to follow that price run up, so that way I can build positions against that run. Okay, this is what the algorithm's doing. As price is going higher, you're led to believe by books and people on the internet and people that want to watch my videos and get clicks and engagements and sound smart. They want to sound smart. They want to be an argument to it. But they're not going to get out here and call the price by every fluctuation like this and use their discipline, their school of thought. They're not going to use Wyckoff. They're not going to use supply and demand. They're not going to use Elliott wave. They're not going to use anything, because all that stuff has nothing to do with why price is going to go up and down, why it stops to a tick, how you can discern where it's going to go, why it should go there, and what time should it do it. So to make the argument that there is no algorithm and see this being done in a live setting, explaining the logic of what it should do, why it shouldn't do this, and then watch this next behavior. Right when it does this, you're saying that everybody stopped selling short. There was no more sellers willing to sell short below this candle's low. And it was only the imbalance of buying that stopped it right to the top of the fair value gap that I told you. Now, for weeks, you've known about it if you've just been watching this mentorship. But I told you in Twitter Spaces in 2023, the first fair value gap after 9:30. That's the one you want to drag across throughout the entirety of the day. I don't put my Twitter Spaces on my YouTube channel. I don't care to have one because I've talked about topics and things that I just don't want on that YouTube channel. But I've given permission for everyone to Twitter Spaces. You all can upload them, make money off of them. I don't care. But the lectures, you cannot do that. I will do a copyright against you. And there's a Chinese ran YouTube channel I'm getting ready to lay waste to this evening. He's converting, or she's converting everything into Chinese. I don't get permission for that. So you're going to lose everything tonight. But the buying and selling pressure did not cause that stop right there on that candlestick. It absolutely did not do that. What's actually happening is the market is delivering that price. It doesn't matter how many people are buying and selling. It's going to stop because it's stopping on its code. It says, I'm not going to go past that point. And I'm showing you what that looks like visually before it does it. So anyone with common sense and rudimentary math, and if you've ever studied anything with computer programming, and I'm a little surprised because I thought that we had in math and science a lot more involvement with programming, and in some of the schools in our area, we have a little bit higher, in Harford County, we have a little bit higher degree mathematics and schooling on the public level. And my kids, they were introduced to computer programming, and it wasn't like they had to elect it. It was just they did a teaching on it, which I thought was great. And for me as a child, when I was in 6th grade, I was teaching myself how to computer program. I was making my own games and little password things that get into files that I would protect using just basic language. And I was fascinated with how things work. So it makes sense to me. And every single person that is in computer science or has ever had a background in, or any involvement in computer programming, when I teach how price is booking, how it refers to specific levels, it's the same thing that they understand by understanding how coding is done, because the market is absolutely one big program. It is a controlled environment that sometimes can be manipulated and disturbed, and that's manual intervention. Barring that, it will act and behave the same way all the time. It's doing time-based delivery. The speed at which it does it is in direct relationship to how close in proximity that inefficiency or liquidity is to market price, meaning this. We opened, we traded down. Now, I had this on this chart in front of all you. I told you we hadn't made one until that was when we had our first fair value gap. That right there, when we went above it, traded back down and stopped dead in its tracks. There is no buying and selling pressure influence. Now, when buyers and sellers come into the marketplace, if you wanted to sell short below that price, you didn't get the opportunity to do that. It never gave you your fill. If you wanted to buy below that price, you did not get a fill. You're telling me nobody had an interest to buy a little bit lower than that? There was no interest, absolutely no interest at all. No buyers had any interest there. No sellers had any interest below that. Think about that. Listen, I love talking about this because I love rubbing everybody's nose in it that thinks that there is no algorithm, because like I get off on this. I literally get off on this. I'm not mad. I don't feel insecure because I can do this every single day and prove that there is one. My hands are all over it. Okay? I mean, I can't say anything more than that. I mean, it can't be plainer than that. If I don't know what I'm talking about, it's going to be obvious, right? It's going to be obvious. But if I keep talking about things that are not germane to anything else out there, despite what people say it's been renamed, these concepts are not my concepts, they're renamed. Where are the other concepts? Where's that logic? Because then what you can do is go into that logic of that supposed renamed school of thought that I supposedly changed the name of, and go in and look at the mechanics behind that and see what is that doing. But see, because there's nothing like that actually occurring, there's nothing me renaming. I'm not borrowing somebody else's logic and calling it something different to impress you. I've invited all of you to do it. Go look and investigate it. You will not see these things. You will absolutely not have time-specific things. You will not have specific price delivery. The PD arrays don't exist in any other form or school of thought in trading. It does not exist. It doesn't exist prior to me. And I say that because I want you to go in and study and look for that, because if I'm lying, you'll see that I'm lying. But guess what happens? You find out that there's nothing else like this. And then you start looking at me do it live, explaining this is what it's going to do, what it's going to do, how it's going to behave. Look at what I just did this morning. I traded ES and I traded the NASDAQ. Okay. I executed with a level of precision that no one else displays. It never, ever, ever happens. That should comfort you. That should comfort you. If I never do another live stream, but I'm going to be doing live streams, obviously, but if I never did another one, you've seen enough. I would have been satisfied with this and said, you know what, there probably is an algorithm here. And I might not ever learn everything about it, but I have seen enough to know that I can exploit these very things that happen, and they tend to repeat. And they're not surprises when they do. Like, I'm not looking at the price saying, oh my gosh, look at that. Hun, look at this right here. Look at this chart just did. Look at the price. Where did that come from? Like, I wasn't expecting that. I'm so excited. Or I'm so scared. Nothing like that happens from me. That doesn't happen. It's boring. I know what I'm looking for. My students have been trained to look for these things, and you're learning more. You're learning more details. And it's exciting when you understand that if it's rigged, okay? If it's rigged, that's a home field advantage. You really think that the markets and the people that run them and they profit off of them like a casino, you really believe, think about this now, you really believe in your heart of hearts that they're going to let the success that they hold right now be influenced by the sheer vast interest of buying and selling pressure of Reddit, of social media? They made a mockery of you over Reddit. And I told you all that they would do that with GameStop, BlackBerry. Hello. Buying and selling pressure has absolutely no bearing on where price is going to go. If you go up into a store, you want to buy shoes, you want to buy the new Air Max. Okay, I need new shoes. I'm going to go in here and I'm going to buy a pair of shoes. I wonder what they cost. You don't know, but you're going into that store. So you're doing what? You're following the lead of the draw. The draw is you want shoes. Maybe you don't need them. You just want them. But you are going to that store. That's the draw on liquidity. Your liquidity. You don't see it that way, but that's how I see it. I'm smart money. I'm cannibalizing you. And I know that I'm going to take price higher, but I have to have fulfillment. There has to be handshaking between a counterparty of buying and a counterparty of selling. Smart money will follow with one algorithm that trades and engages with the price engine that is the algorithm. So in other words, think about it like this. If there is a mechanism that causes the fluctuation of price going up and down, okay, as we see here, we open, we fluctuate, and we drop lower, okay? It went down below here to absorb what? The sell orders. What vested interest would there be for an entity that we're going to classically refer to as smart money? What benefit would that be to go below here to engage these sell stops? It's not for the express order of letting those make money going down. That's not what it is. It's for smart money to accumulate the sell stops that are resting below these relative equal lows when there's an unfulfilled range up here and unfinished business, that range that was created by the imbalance of the opening range gap. So previous day settlement, which is this heavy dark line here, okay, noted here, that's 4:14 p.m. Eastern Time's last print. And since its session ends at 4:15, you're not going to see a price at 4:15. So therefore it stops at 4:14. It's still trading electronically until 5 o'clock, and then it stops and pauses for an hour and resumes at 6 p.m. Eastern Standard Time. But we drop this area all down in here is the market providing ample time. It's providing opportunity for smart money to absorb and be counterparty to those sell stops or sell orders that sell on a breakout lower. So all of this here, all of this is accumulation of individuals that want to be sellers. Now, they could be selling to protect a long position, or they want to sell on a breakout as it drops down, like a momentum trader. It doesn't matter. We don't care what type of classification the sell orders are. We just look for relative equal lows. Okay, that was my point in trying to create this language. I have tools, and I can discern how much of the buying and selling pressures, okay, you want to use those terms, above or below old highs are, how much are pending orders for breakout or continuation, or stop out and be neutralized on an existing pre-positioned trade. That means buy stops taking out shorts, sell stops taking out longs, or sell stops, new entry for breakout, buy stops, breakout for new longs. I have ways to determine that. But that stuff, you're not getting that stuff. So to create a language that allows us to communicate and understand what I'm saying and not cross lines I don't want to cross, I use this language of relative equal lows. That's easy. It's visual. They will never stop making relative equal lows and relative equal highs. They're going to be there. It's going to be there all the time. Every time frame is going to be there. But when you have them at times where the market starts to trade and there's a large volume influx where there's a lot of traders coming in, that's why it's easy for people to believe the myopic bullshit of people repeating and regurgitating lies about what makes these markets go up and down, which is buying and selling pressure. The market stopped going lower because it ran out of sellers. What? That's bull. That is bull. It stopped because it's already done enough of a range drop down here. There's enough absorption of all these sell stops. So the market is affording people that need large pools of liquidity to be counterparty to their trades. They can't fulfill the measure of volume that would be allowing them to profit efficiently because they're trading a large amounts of money. To get back to that full gap closure of yesterday's 4:14 p.m. Eastern Time, that line right here, to get to that price and the volume that they're trying to shove through the marketplace, it's not efficient for them to be buying most of it as it's going up because the delivery to terminus is already started. They have to do it when the market's going against it. If this is where the market's going to go, and I'm teaching that to you, focus on the initial opening range and where that opening range gap, if there is one, because it's going to have a 70% chance it's going to fill half of it in the first 30 minutes. That in and of itself is algorithmic. You don't hear people teach that in books. Find it in a book. Find it. It's not out there. It's going to be in everybody's book now, but it's not out there. You're familiar with opening range. Oh, opening range, oh, it's this, that. But they're looking at different time frames, 15 minutes, 5 minutes. That's bullshit. It's 30 minutes. That's what this algorithm is referring to, okay? If it won't hold up to scrutiny with me calling it and outlining it live, that means it's not real. That means I'm a fraud. That means it's fake. It's made up. It's contrived. But how many times are you seeing it work? It's perfectly. That's my emphasis here. Because I say this not to defend myself. It's for the folks that tell me that they're being influenced by other people because they're so new. And I'm just saying, don't believe me because I said so. Never believe me because I said so. You listen to me, determine what the parameters are to go into the marketplace and see it for yourself. Go back. It doesn't take long to see if there's anything here valid or not. And then go into the live streams. If you're brand new and you're trying to learn how to do what I'm teaching on this YouTube channel, there's no better way to start than what you're doing right now in 2024. Because I'm literally proving unequivocally. It's irrefutable. It's absolutely irrefutable. That's why I said I can do this in front of a court. I can do this in front of the Supreme Court. I can do this in front of the CFTC. I can do this. I'm doing it live right now. They're probably watching me. Hello. Hello, Lydia. That's who was the lady in charge in the 90s when they served me paperwork at my aunt's house because I wasn't putting risk disclaimers up because I was stupid. You're a 20-year-old, didn't know what I was doing. I was talking about the markets and I didn't even report the level of risk that's involved. That's why you see my disclaimers in the information box on every video I put. And that's why you see the disclaimer shown before I start talking to you. I learned that lesson in the 90s because the federal government literally said, hey, you, you don't know what you're doing, bud. And I had to stop. I just said, okay, I'm not doing that until I learned that these are the risk disclaimers you have to have. That's why when I reach out to other YouTubers and I tell them, look, you're potentially in trouble here if you don't start doing this. And a lot of people laughed it off, but eventually they started using it. And that's all I want. I don't want to see anybody get in trouble because our government sometimes has a little bit of an overreach. And while I wasn't doing anything that caused anybody losing any money, in fact, they were actually making money off of what I was saying. I was teaching before I should have because I didn't fully understand everything I was doing. Clearly indicated by me not revealing the disclosures of risk that needs to be given to the public. So there's a lot of laws, folks. There's a lot of laws and regulations. And I love doing what I'm doing, but I'm not going to do something that's against the law. I'm not going to go out here and put myself in jeopardy just to impress you. I don't care if you like me. I don't care if you believe me. But I say these things and I talk about the algorithm because there's students that are brand new. And there's new waves of new students always coming in. And it helps reinforce what I'm already teaching anyway. It's not like I'm saying something you can't learn more information about or feel more confident in. I mean, I understand some of you will say, well, we get it, ICT. Can we move on? We understand it's an algorithm. But the elements of every individual day and how it delivers, I'm revealing that to you. I'm giving you the mechanics of it. And buying and selling pressure, the markets are for the deep pockets. They're not for you. They're not for me. They're not for John Q. Public. You know, the stock traders, the old ladies that sit around, they have their stock buyers club. It's not for them either. It's not for them. It's for these deep pockets to fleece you because we are all cattle to them. That's the reality. And how do we get to be a part of the same game they're running? Use what I'm teaching. And it's literally, you cannot refute it. It's there. Now, the folks that don't want to believe in an algorithm, they'll have to backpedal and say, well, he's just a really good price action trader using other people's stuff. And my question still is, where's the other people's stuff? Where is that? Where's the rules that I'm giving you, the time elements? That's not anywhere else, okay? I'm so sick of hearing a go box. I ain't seen one person come out here and outline the profile of the day, the time at which it's going to behave, where the imbalances are going to form, how it's going to be utilized, stop on a tick, use a stop loss, put a stop loss on your trades, Make them tight with logic that repeats. It's already been taught in this YouTube channel. Okay, but find the other logic. It's not there. But it's so easy for people to be influenced because they watch somebody else say something. Oh, and the more emojis in the comment, it must be valid then. Like emojis, in my opinion, they invalidate any argument. As soon as you start putting emojis in your post, I already know I'm talking to a kid. I'm already talking to a kid, and they're clueless. So deep money, smart money, big players, okay, they have to have the opposite end or counterparty to their intended trade. Okay, so in this case, it's the sell stops below these relative equal lows. So the market drops down, which is interesting because we only had a little minor little run above, and then it drops. Then it gives you the fair value gap here. See that? Drops into the sell side, spends time down here. Where is their inefficiency? When it goes below these lows, at this moment, right in here, at this candle, where is the inefficiency in the marketplace? There. And the remaining portion of the opening range gap that was yet to be filled from that high up to that dark line. So there's unfinished business up here. So they're tipping their hand to you by dropping it initially. What's the most time they spend on the sell side? They're accumulating. Remember the other day I was telling you we were watching price action. I said I don't want to see it accumulate inside the consequent encroachment of the wick of the candle. And it went down, stabbed down there, and immediately came right back out of it. That's the opposite of this. This is accumulation. Accumulation is the market spending time. It has to spend time at a predetermined area where liquidity is, where inefficiencies are. Inefficiencies are best suited and used one time, right in there, quickly, hit it, and run. It can be used again, but we don't want to see markets go into inefficiency like a fair value gap here. Like we don't want to see it go up here, meander around, create a bull flag, right, Patrick? No bull flags required. Okay, we want to see it trade to it, through it, come back down, treat it as what? A springboard. Rocket fuel, baby. Send it higher. Inefficiencies, we don't want to see it spend time inside them. Liquidity, when you're going to be trading with the daily range or the largest magnitude in price delivery, which side it's going to move on most, okay? The more time it spends below a pool of liquidity, it's obvious like that, that's allowing and affording smart money to do what? Load it up. Load it up. And then it starts to reprice higher. Smart money is not buying as it's going up. They will buy right there. Why? Because it's coming down to that inefficiency. And it's affording them still a range to get to full gap closure. See that? So it trades down to the top of that, stops right on a tick. What is the low of that candle? You're going to be looking at this value right here, upper left-hand corner where my cursor is. See it? You're going to look at that value right there. That low comes in at 19,505.25. Okay? 505.25. The low of that candle comes in at 19,000, ready for it? 505.25. But there's no fucking algorithm. It never gets old. It never gets old. Come on, Mr. Option Dude. Come on. Come at me, bro. Oh, this is so good. Oh, man, I'm so entertaining. I love it. I love it. I could entertain myself every day out here. I wish the markets traded on Saturday and Sunday. I'd be doing it then too. That's perfect. Tell me where Wyckoff ever gave you perfection. Nope. Elliott wave never happened. Supply and demand, who the fuck knows inside those zones you're buying and selling, right? What price is perfect in the zones? Nobody knows. But there's this old guy. This old dude in Maryland. He's got a really good lucky rabbit's foot up his ass. It's unbelievable. It just keeps repeating. He can't keep getting away with it, right? Anyway. So we're back inside. Remember I told you when these form, it's like a huge black hole. It's going to draw price into it. Keep pulling it in, pulling it in. So if you ever see nested new day opening gaps, new week opening gaps, or vice versa, and this is just a beautiful, beautiful, this is like a poster child of the event I'm telling you about, where it draws price into it. So smart money has to buy where there's liquidity, okay? They're absorbing counterparties, and it's never going to be able to be hidden from you. Below old lows, there's going to be sell stops, okay? Above old highs, it's going to be buy stops. When you're watching price action, okay? When you're watching price, you're trying to get a feel for it, and you won't know how to do this initially. You won't have a feel for it for a while, because it takes experience seeing and reading price action live. And you'll get the rules that I'm teaching you, and you'll start seeing example after example. Take a screenshot of that, by the way. Such a beautiful element of delivery right there. It's such a good thing. Man, it's so good, isn't it? Isn't that beautiful? Where suddenly all this stuff makes sense. It gives you a rhyme and a reason. It gives you a script to expect price to adhere to. And once you understand that script, what it should do, how it should behave, if it ever goes off script, guess what that means? It's not a time to over leverage, right? It's not a time to get in there and press the button. You need to sit still. There's something going there. There's a deja vu moment there, like in the movie The Matrix. Something has changed. And that is not always an invitation for you to be doing something in the market trading. So smart money has to buy down here because of the volume that's required to be counterparty to their trade. So if they're buying, they want to be a buyer, they're going to be buying in large pools of liquidity. And they will add, okay, they will add as the market trades up, but it has to be on sell side delivery. That means momentum, delivery of price going down. They will never, ever, ever buy on an uptick. It never will happen. It never happens. Smart money is never buying on breakouts. It's not happening. It's never happening because they have to have discounted prices. So this down close candle is the first discounted delivery from the perspective of looking at all of these up close candles. Even that's a small little up close candle. So this just so happens to be at a fair value gap. I told you conceptually that it will be formed between 9:30 and 10 o'clock. It's the first one. And then because we've spent time down here taking the sell side accumulated, we want to see it run above here and watch, does this treat this same range? Does it invert that? Because remember, it was over here. And when price is up there, it drops down, uses it, then springs higher. Goes below it, inverts, goes down here. Now watch this level in here because it's going to do what? Change its character. It's going to revert back to what it was over here. Then this now becomes what? This is now a reclaimed bullish fair value gap. Why? Because it was acting as one before. Where did that happen? Right there, folks. So stop saying that I did something wrong in my lecture. I did not call that fair value gap an inversion fair value gap incorrectly. It was how it's used. How is it used? And does it change its mode of delivery? How is it influencing price? So this has become a reclaimed bullish fair value gap because it should have been treated as such over here if the underlying narrative is bullish. So that's what I'm saying. When people say all fair value gaps are the same, you're an idiot. You have no idea what you're talking about. Stop talking like you do because you have no idea what you're saying. And stop trying to teach them. Say, this is how I use them with my present understanding. You know what? That's very disarming. It's a fair statement. No one can look, especially I'm the author of it. I can't look at that and be, he's pretending to know something he doesn't know. Because everybody up to this point that has ever taught or lectured anything about a fair value gap, trying to teach it, you literally have no idea what you're talking about. You literally have no idea. You haven't spent enough time with me. Seriously, you haven't spent enough time. And I haven't taught everything about them yet. You're just introduced to them. You're familiar with them like, oh, I've seen that before. But you can't explain it. In hindsight, you can. With market replay, you can do that, obviously, because then you have the benefit of saying, well, it behaved that way there. But I'm telling you where they're forming before they form. How they're going to react. Can you argue that? Make your videos today. Expose me today. Go on YouTube, make your video, make sure you put the @ symbol, inner circle trader, all one word, and I'll see your little video, okay? And I will gladly come to your channel and I'll leave a comment because that's really what you want, and we can all laugh at you, okay? Because there's no way you're going to argue this today. There's zero way you're going to argue out of it because it's given to you beforehand. The logic, how it's going to behave, and then what it looks like. You've seen that, but how and when it's going to form. How will price react to it? How is it going to react off of it? And it's not, there's no more sellers here. There's only buyers coming in. Only buyers are outnumbering. Think about the stupidity of that statement. Every buyer has to have a seller, okay? So there's an imbalance of buyers. How the fuck's that possible? Because for someone to get long and filled, they have to have a counterparty that's sold to them. That's how the markets are booking, right? Look at your depth of market. Look at your DOM, okay? Not DOM, DOM. Study them, not for the express purpose of learning how to use them to trade with, but look at the facade they present to you. They're just numbers there. Those orders are coming and going. Maybe they'll be there when the market prints that price and books the mark to market. Maybe they're not going to be there. It happens all the time. Market participants, Goldman Sachs, Citi, any other large conglomerate, they could put an order in and say, you know what, I'm going to pull the order for whatever reason. And you can read between the lines on that. Some entity out there could do things like that and spoof and give the false impression that there's a lot of interest at this level. And things like Bookmap and stuff like that. If you know that there's a large likelihood, okay, from a narrative perspective, that once we were down here and there's a large pool of orders that you see on the depth of market that's below this area down here, and we start seeing this right there, I'm telling you that doesn't matter, that there's so much orders below here or at a lower price. But see, some of you think that that's somehow a magnet that's going to cause the market to say, look at the number, look at the sheer number here, when that's not really what's going to be pushing price around. It's understanding how the market's going to work with what it's been given to you in the first 30 minutes. Using the footholds with these PD arrays, this was the sheer mountain, side of the mountain, okay? We go down. You got to climb back up top of this and get to some zenith higher level, the undelivered gap opening. Well, as you go up this range, you have to look inside here. Where are the footholds? Where are you going to reach for? If your price, and I'm going to personify price as your price, and you're down here, what does it have to do? It has to get above this first. Well, that's an easy one. It gets above that, no problem. Then you have an old foothold here. So you use it, pull yourself up to it, and once you get above it, now it becomes a foothold. So it's a handhold first, and then it becomes a foothold. Oh, he's just talking about supply and demand. He's just talking about support and resistance. Well, did you call this beforehand? Did you trade it? Did you live stream it, outlining it live, that it was going to behave that way before it did it? This is how you cancel anybody that's challenging you with the intended purpose to discourage you. There would be no way anybody could discourage me from learning this from someone like myself doing this live. There's nothing anybody could ever say to say, you know what? I ain't listening to that guy. He's shady. He's a shady guy. You never trade live in front. I'm going to trade live, but I got to give you the logic, what I'm using, because otherwise you're going to be like, I don't understand why you did that, because it's the same stuff I'm showing you every day. But you have to get comfortable with this, Caleb. You have to see it repeat over and over and over again. And by seeing that without any money, without any clout behind it, whether you win or lose, without any, I'm going to impress dad or I'm going to probably disappoint dad behind the execution, you're just observing price. So that way there's no heat on you. There's no pressure. There's no requirement for you to be right. So you're just observing what price is doing. And these things that I'm teaching will repeat and repeat. So back to this. So your price, I'm personifying price with you. You're the individual that is price. When you're down here, it's got to get above this high here. It's going to get above that rather quickly. Why? Because that is a shift in market structure. You want them to be sudden and abrupt, just like that. Okay. When it does this, your eye goes back to all of this range. Now this range just so happens to use reference points that was given over here. So this is a PD array that can change its characteristic and role of how it's going to behave, either impeding price or supporting or rejecting price. Meaning it was a potential bullish fair value gap that was realized right here when the market dropped down into it and then sent it up. Then we went down through it, excuse me, making this a inversion. So it's not bullish anymore. It's going to be used to send price lower. It does so. Then the market starts to come back up. Abruptly, shift in market structure. What's your first PD array? Well, you're in one. It's the old bullish fair value gap. So now it's reclaimed. Why? How is it reclaimed? Because it went above it. And we're opening here, trading down into it. It should act as what? Support. Real support. Not the stuff you see in books. And it's not supply and demand. It's none of those things. Wyckoff has nothing to do with that right there. Wyckoff, if he was alive, he's writing notes right now. He's in the same classroom you're in. He would be writing notes and then sending me emails saying, what about this and what about that? He'd be doing that. And that sounds arrogant, but that's just the fucking truth. So the next thing is when we get above it, we get into this gap here, which just happens to be the first fair value gap that forms between 9:31 specifically to 10 o'clock, because your fair value gap can't form on the 9:30 candle. Okay, so there's a rule there. Find that in your books. So once we get above it here, opens, trades down to the tick, stops. Smart money can add in that, but they're not adding the volume of orders that they pushed in here because it's not enough time and or liquidity offered to counterparty with them. You see what I'm saying? So when the market is allowing and affording in pools of liquidity, when there's a gap that's yet to be filled, they haven't even touched the halfway gap or consequent encroachment of it. And we have this big, huge black hole of a new day opening gap and a new week opening gap. How many times has it been trading back and forth to it over the last couple of days? Think about it. Think. It's not one and done. It's not pivots. It's not floor traders pivots. Okay. Oh, it trades the R1, R2. Okay, well, it's done. Throw it away. That's not the logic we're using here, is it? This is what the algorithm refers to. These are old reference points. They are arrays. If you are a trader that has any familiarity with computer programming and coding, you know what an array is. It's a reference point where the market, or not the market, the algorithm, or program, if you will, refers back to a data point, a reference point. An array is for that express purpose of using something for data, number crunching, what the algorithm is going to do with it, like a recipe. You have all the ingredients. You follow the step-by-step process of making whatever that dish is that you're making, okay? But you are the composite man. You are the market maker. You're literally taking the ingredients and following the step-by-step process of making the outcome how you want it. Sometimes something is a better condition for them to disrupt. And that means that sometimes the outcome isn't always the perfectly cooked pot pie. It may be overcooked and it may be undercooked, okay? But they're still left with a pot pie, right? So they can profit from that. They got something they can work with. What does that mean? If they can't buy as much here, how's that any benefit? Because it won't spend that much time there. It isn't going to run out of potential magnitude and speed. In fact, you're expecting it to start doing the very thing, amplifying the directional run and speed, and the candle should start expanding larger. And you get that here, reading up into the full gap closure. So they won't get that many positions, funneled into the marketplace because they have very little time to do it. But we, as smaller entities in the marketplace, we have no problem pushing our orders into that candlestick right there. Whereas the volume that they have pushed in down here, accumulating a larger position because they see this run here. You can't see that yet. You're learning the beginning building blocks of that. But it starts by having these understandings. Looking for things that are going to be in the marketplace. They cannot hide them from you. Tell me how they're going to hide the first fair value gap between 9:31 and 10 o'clock. How is that possible to hide it from you? You're not looking at the screen. That's the only way it's going to happen. You have a blackout, there's power outage, internet goes down, TradingView or whatever your platform has a wonky technical glitch. That's the extent of it. That's how it's going to be hidden from you. But they can't hide these things from you. If they would change these logics, these elements to it, okay, I would have never taught it to you. I mean that. I've never would have taught it to you if it could be changed by the participation of everybody else. Would you share this information? And be honest for a second, okay? Let's take a moment. I'm gonna take a drink of my water here. But if you knew all this stuff, would you teach it to anybody? And be honest. You might be a Christian. You might be a good person. Would you teach this to anybody else? I'm gonna tell you something. If you say yes, you lie. You're lying. You wouldn't teach it to nobody. You'd be greedy, self-centered, selfish. You wouldn't even talk about it with your friends. So the question is, why am I doing it? Inquiring minds want to know. Say I can't, and I'll make more of me. That's what I said, and that's what I'm doing. In the future, you'll understand what that means. But for now, just know that this is a gift, and you should be very, very thankful for this because it's not worshiping me. You should just be thankful that it's like this in the marketplace, because if there's an algorithm, if it's controlled, if it's rigged, that means you're never going to be duped by buying and selling pressure randomness. Think about it. How could you possibly sleep at night, laying your head down, thinking, man, I hope I can outsmart all the buying and selling pressure randomness tomorrow. Like, how could, it's like you're playing the lottery. That's stupidity. That's stupid math, okay? That's math that doesn't math. There's no probabilities there. Why would anybody want to work with that? Oh, well, you can do this and you can, bullshit, okay? Bullshit. Show me this and anything else. It's not there. So if we get through these levels here and we have this delivery and price and we get above this short-term high, then we can anticipate what? Low, high, lower low. This disrupts what? The liquidity. It absorbs it. This up close candle here is your bullish breaker because it broke the market structure and it took anyone that's long out. So that way now the buy side is neutral, meaning that there's no one long above here. They've taken out anyone that's long here out because they raked it down lower. So sell side's been engaged, and now buy side is negative. It's a vast wasteland. There's no heaviness. There's no held positions inside this range here. So they're going to start accumulating when it gets above there. What does accumulation look like? Is it fast, one time, one candle, and then run away? No, that's redelivery. Accumulation in this candlestick right here. Big paradigm shift coming. Ready? Fasten your seatbelts. That candlestick right there is your bullish breaker. And we can take this extension thing off here. We'll shade it. Make it green. I haven't used that color much. Right? So in here we have that whole run. Now, if you're looking at a PV array like this, like a breaker, and you're expecting it to offer some measure of support, rejecting lower prices. So it's going to be like a brick wall saying, no, you're not going to go through me. What would that look like if you have a candlestick like this, where you have this big discount tail. Let me move it over a little bit so you can see it. See that tail right there from the open of the candle down to the low, where it acted off of that fair value gap that I showed you live. Then we closed up here. When a candlestick like this for a breaker is forming such a long wick like that, the wick does what? What does the body do in contrast to what the wick is telling us? The wicks do the damage. That means it can color outside the lines. Generally, the bodies don't generally color outside the lines of a PD array. It can, but it's got to be like one tick, no more than two. But a wick can go a few ticks outside of it. But generally, I allow it to have two ticks on an index like NASDAQ or S&P. S&P generally is like a one tick mohawk, like a little tiny fluctuation above or below the parameters for a fair value gap, something to that effect. For ES, it's tighter because it's a little bit more of a gentleman's market. It's a little bit more refined. The NASDAQ is kind of like a hooker on a Saturday night. It's just she's usually drunk and she's a sloppy mess, but she's fun. She's fun to be around. You just don't want to marry her. The ES is a lot more refined. It's a gentleman's market. It behaves a whole lot more tame, and it gives you a lot cleaner price action. And it's a little bit slower in its delivery, but you can still make a lot of money trading that one too. The ES is not as exciting as the NASDAQ is. I like me a good Saturday night romp, and this is what it's like every day trading it. It gives us the opportunity to get in there and have a good time. But you have to wrap up. You got to wear a stop loss because you don't want to be out here messing around with this thing and pick up something you don't want. So when it has a wick like this, I don't know where this stuff comes from, folks. I really don't. I have no idea where it comes from. But that is the body, okay? So since I'm bullish, I want to look at the highest portion of this candlestick, okay? And I want to be in the upper half of that. Why? Because that's the rules of engagement with my PD arrays. If I'm bullish, I don't want to see the lower half of any PD array traded to. I want to see it have the inability to do that. So in the lower portion of something that would be deemed bullish, it should fail delivering price in that. You see the logic there? That's not supply and demand. That's not Wyckoff. That's not anything else. It's a very specific phenomenon that I'm taking your attention to, that I'm using when I'm reading price and I'm executing on. That's what's really going on behind the scenes. So if that's the case here, that body starts here. I'm not worried about that wick. I don't care about it. It's the body. So all of this range up to the high, I have to see what that range is. So it's the upper half, which is this level right here, that line. That's what it's showing you, okay? So when the breaker's being utilized, it's better for the sensitivity for price action to be between this level here and the high of that candlestick. Now, as price gets above it there, how does it behave? Upper quadrant, upper quadrant, upper quadrant. Can it even touch the halfway point? No. What is the body's doing here? Is it spending a little bit of time and then moving? No. What's it doing? Same thing it did down here. It's accumulating. What's it accumulating? Positions. The algorithm is staying in here, holding it, holding it, holding it, holding it, allowing smart money to do what? Capitalize on that bullish breaker. It the levels when you expect it to. Then rallies. Consolidates around what? The high or the previous day's settlement price, 4:14 p.m. Eastern Standard Time. That's the high or top of the gap, the opening range gap. So if you traded above it, go back and listen to the other lectures about it. If we're above it, if it's bullish, it'll come down and start doing what? Treating it as support. What is it doing here? Marking time sideways. Why? There isn't anybody trying to buy it? There's nobody interested in going short? I thought buying and selling pressure moves price. Oh, maybe it isn't that. And then the market takes a run here, digs into the new day and new week opening gap clustering, how we started this lecture. What is Caleb going to be looking for? Clustering of new day and new week opening gaps. And when you have them on your chart, don't look at them being traded to and delivered to and think they're done, they're dead, they're stale, throw it out like supply and demand logic does. Keep them. because the algorithm is going to refer to them. We still have plenty of time to use them. What do you think I taught the if the data ranges for? 60 days is not longer. As a young man that left a comment saying, you made a mistake. You said that 60 days. How many trading days is there in a month? If you have 30 days in the month, it's not 30 trading days, but you're using 60 trading days. Look back. Because I've been doing a lot longer, and my hands are all over this, and they're my concepts. When I codify these things, I have set boundaries and parameters that I want to use as reference points for my use. Mine are 60 days in the past, so 60 trading days. Go backwards. My PD arrays, depending upon how I feel about a market structure and where I think the market may go, usually I'm not looking at PD arrays that are older than 60 days of 60 trading days of look back. It's not calendar days. It's 60 trading days look back. And then 40 days. What do you think is going to be more sensitive to price? A 40-day old PD array or a 60-day PD array? Or in other words, a fair value gap that's 40 days old or a fair value gap that's 60 days old. Which one's going to be more sensitive? The 40-day. What's going to be more sensitive, a 20 or a 40? 20. And if you have PD arrays that are forming, inside the last 20 days, you're working with the actual most active PD arrays. And if you just focus on them, you never have to make it complicated. You never have to worry about having anything older, because they're always going to be in the chart. You'll see them. They won't hide from you. They can't hide them from you. That's my point to you. Like, you're stressing about all the things that are not going to be that big of a deal for you. And yet the time and the energy of worrying about it's going to stop working. It's going to be the new retail. There's no traps, folks. Does it look like it's not working for you? Does it look like the person that's created this stuff? Does it sound like I don't know what I'm talking about? I'm explaining this stuff to you so that way you can go back and look at old moves and see that that's exactly how it is. And then you have the perfect opportunity to study going forward. And if it's changing, if it doesn't work anymore, it's going to be glaringly obvious. Everybody will notice it, not somebody that has something to sell as an alternative, right? So, or make some kind of drama video because they're hungry and they need groceries. So that business is closed there. And when we're trading down, the wicks are digging into an old new day opening gap. See that? Or that's actually yesterday's. All right. What's today's date? I'm getting disoriented here. Yeah, that's today's, the 27th. Excuse me. So anyway, there was something else I wanted to say about that breaker. I got disoriented here, talking other stuff. Yeah. So anyway, the accumulation aspects of price delivery here, it's when it's spending a little bit of time. When you're in the narrative, you're expecting higher prices. You start seeing these little consolidations in here at the levels I'm teaching you and at the time at which they should form. So when you start blending these elements together, you get like a really rich tapestry of seeing what price is going to do and how it will behave. And you're not surprised by it. You can anticipate when it starts running, when it starts making big candles in your favor. And then you can also predict and anticipate, okay, it's moved a little bit now. We can expect a reasonable retracement. It doesn't mean it's reversing. It's just going to seek a short-term discount. And then you keep that narrative in mind until you get to around 11:30, 12 o'clock. And then it goes into the lunch macro. And then that's when you expect it to have some measure of deeper retracement. And you find the first low prior to where the market's trading in that range that forms in the lunch hour. When I say lunch hour, it's technically 11:30 to 1:30. Okay, but it's an old habit of mine saying it's the lunch hour. It's the phenomenon that takes place between those specific 2 hours. Okay, so there's a lot of things that are happening there. At 11:30, you're seeing London close. So traders that are trading on markets like the CFDs, they're trading the NASDAQ 100, the S&P 500, CFD. they're usually closing up shop. They're ending their day because they're going to do whatever they're going to do. And we still have the afternoon session still here. And I want you to think about how ridiculous it is to try to build the argument about why price goes up and down and stops exactly where I'm teaching you they're going to do, right to the tick. If it was buying and selling pressure, okay, then these levels, these concepts wouldn't be so perfectly pristine and accurate. Like they would not be as perfect as they are if it was just buying and selling pressure. Because these things I'm teaching are not in anybody else's logic. There's no other school of thought that leads you to come to the conclusion that, okay, this is an area to buy right here at that very candle, and it should not go any lower. It completely kicks the balls in on the argument of the buying selling pressure. Because I guarantee you, at depth, if you look at the depth of market, look at the ladder, okay, you're going to see all kinds of orders that are resting below that low of that candle. Why didn't it go down there? Well, there was more more what? More buyers. It literally drives me crazy. Like, you have to be fucking stupid to see it like that and say, yeah, it makes perfect sense. You're only saying that because everybody's been repeating it. Repeat it over and over again. Hitler said that. If you keep saying something, tell a lie long enough and loud enough, eventually everybody's going to believe it. I'm not lying to you. I'm telling you what price is going to do before it happens. And they're standing on some ass backwards logic and arguing against it with nothing to prove against it. Nothing. So the individuals that are leaving those comments to me, and you're brand new and you're very influential, right? You're easily influenced. I want you to just look at what I'm teaching. I'm not showing you something in market replay. I'm showing you something live. I'm calling it and outlining it live. I'm giving you the things to think about before it does it. And then it does it. So how could that happen? If just buying and selling, which is random in nature, if the buying and how do we know? How would the market know? How would any trader know the effects of buying and selling pressure and stopping, no more selling below that candle's low? But that's exactly what I told you to look for. When it gets above it, it's going to come back down and use it as an inversion fair value gap. And it delivered it perfectly to the tick. It's silly, isn't it? But it's also confidence building. And that confidence, when you start seeing this stuff for years, decades, 3 decades, it gives you a little bit of a swagger, okay? You get a little bit of John Wayne in you, okay? And these new people, okay, they're just brand new. And they think they know everything because they've read a book or they're a part of an organization that calls them a chairman. And all this stuff builds their head up like they think they're smart. They're some kind of intellectual giant. And that's why they don't do well in trading, because they're a facade. They're a gimmick. They're a clown. And that clownery does not equate to making money. The only way they make money is lying to people, fleecing people with lies and ignorance and deception. I'm not deceiving you. I'm showing you the logic beforehand. And it's liberating, isn't it? Isn't it fun? Knowing that the guy's talking to you, I got nothing to sell to you. There's no more catch, okay? There's no come back and give me money. None of that's required. And I'm enjoying it. Isn't it fun? This is college done right. This is college done right. This is ICT University, okay? Everybody's tuition's free. You're all getting scholarships. It's brand new logic that you're in here. You're in this dynamic pool of information all at the same time. No one has an advantage over you. Isn't that fun? It's exciting, isn't it? So anyway, any PD array that you're looking for, you want to see the upper half of it when it's bullish. Respect it. The lower half, it can trade to it. It just means that it better damn well respond off of it when it gets to the deepest part of it. And you want to see it immediately reject that. If it doesn't do that, chances are you have a dud. And there's no harm in just canceling the trade, getting out at whatever you have. If you cover the cost of the trade and you just get a scratch or you just lose the commission, that's a good thing, folks. Versus I don't know, holding on to it and trying to find some other supporting logic, going on social media, see if anybody else thinks about this. Hey, could you talk about gold? I'm not talking about gold. Stop asking me, okay? Gold is a highly manipulated market. It's trash. I told you it's going to go 3,600. There you go. Done. If you're long, hold on to it and don't let go. There's a lot of stuff happening over on the other side of the world, and it's going to be coming over here on our side, and it's going to cause gold to go up a lot more. I'm not trading gold. Okay, I own gold, but I'm not trading gold. Okay, and it's not in some deposit. They're holding gold for me. I have my gold. Nobody's holding my gold. If you ain't got it, you don't own it. If it's not in your hands, you don't have it. So stop asking me about gold. If you're losing money, chances are you're trading gold. So my question to you is, everything I've outlined here, I'm going to close this one because I'm hungry. I'm going to go get something to eat. No, actually, I'm sorry. I had to hurry quickly go over the trades I did, so that way you can get a feel for it. The where the market is right now, screenshot that, just like it is right there. Screenshot that. Okay, and then you want to go into your charts with this screenshot. Do not use my charts for your journal. That's a lazy person's approach. You go in and you model everything you see here, and you study why these reference points are even pertinent. Listen to me, okay? Stop for a second. I know you're probably all buzzing right now. You're thinking, this is ridiculous. Look at this thing. It's running exactly like he said. Right. But listen, calm down for a second. Do you want to learn how to do this? Or you just want to be entertained by me talking about it? Because if you just want to be entertained, that's nice. I don't mind you hanging out and studying with us with no real intent on using it. But if you really want to learn how to do it properly, where you don't need me anymore, I promise you, I will not get my heart broken because of that. I promise you, you won't hurt my feelings if you never come back to watch my videos anymore because you've learned how to trade. You will make me the proudest mentor if you do that. That's exactly what I want for you. I don't want you watching other YouTubers. I don't want you watching other live streamers. I don't want you subscribing to anybody else on social media because you're doing that because you need something from them. Inspiration, motivation, trade idea. You want to copy them. Or worse, you're looking at their results that may not be entirely true, and you're looking at your results and you're beating yourself up. And that's not something that I would want for you as a teacher. I want you to learn how to do this properly. And the only way you're going to do that properly is if you dress your charts the same way you see mine, but they have to be your charts. You're welcome to use mine as a guide. You're absolutely welcome to do that. Whether you're watching the live stream live or if you're watching it later on, watch the price action, okay? Watch it. Watch it one time, listening to me, and take notes. Then watch it again with me not talking. Really watch the fluctuations of the candlesticks. That's why I always adjust to keep the candlesticks in view, because I want Caleb being able to go back and watch this stuff, studying how it delivers every individual candle, how it behaves with the levels that were already on the chart. You're telling me that everybody out there buying and selling pressure was using that level right there on an old new day opening gap on the 23rd of August? Why would they? If they're not using what I'm teaching you, why would they do that? Why would they do that? What's the logic behind that? What makes it a high probability turning point if you're going to use my concepts? Why would you expect it to behave that way? Because it touched that level right there, that old new day opening gap low, and it's the lower quadrant of the new week opening gap on the 18th of August as well. That's two things. What's the third thing? Consequent encroachment of that wick. Bam. Stop. To perfection, to the tick. Higher goes. Think about it. It's fascinating, isn't it? When I started seeing these things where I could communicate it in a way in the chart, because it's very hard to find them. It was very, very hard to find things that I could overlap and say, this is what the algorithm's doing. But to teach it conceptually without saying, here's the code. Here's what it does. I have to find something that allows you visually to see what it is likely doing at that very moment. There's lots of other things that it does that I can't bridge the gap with, but I am aware of. And that's the part that makes me who I am. I can look at things and say, it's going to do this, it's going to do that, because I have something you're never going to get. And you get mad when I say that. And you shouldn't be mad. You should not get mad by that. You should say, you know what? This is just further evidence for me to say, I don't need to worry about this. I have an advantage. Because it's rigged, I am not going to be fooled by randomness. If it is ran by an algorithm and if price is controlled by an algorithm, that means if I focus on the things that I'm being shown here and taught and it's been proven in other people's hands, not just Michael's, I have profitable students that use this stuff and they learned it from the free lessons on this YouTube channel. They didn't all come through my paid mentorship. I have profitable students there, but to prove to everyone, I gave it to the entire community right on this YouTube channel. And you have to go through the lessons. But if you haven't gone through any of them before, this is the right one to start in, this one here. Because you come in and you hit the ground running. I'm literally doing it over live charts, explaining the logic. It should do this, and watch this. It's going to behave this way. Watch, and then you see it. No one's going to tell you you didn't watch this pan out today. If you were here live, you saw it. You watched it pan out. The dynamics of when it's accumulating below old lows for the purpose of accumulating the stops, it's spending time now because it's going to be a longer protracted run. Does your chart show this around here? For the YouTubers, all of you, okay? All of you. Some of you I have an affinity for, and we talk in private. And others, I rib you, and you rib me. It's fun. It's fun. I don't have any problem with that. I mean, you're not gonna make me forget this stuff, and you're not gonna be able to discount it. No matter how hard you try, you're never gonna be able to discount what I've shared here. It's proven. It's proven logic, and I have more students that are making money than anybody else out there on YouTube. And they're bringing the receipts. And all of you listening, you're the next round of that. You're in the monsters lab right now, okay? And if you are a YouTuber and you're out there and sometimes you have a little bit of a victory here and you have a little bit of victory here, you have a little bit of a run of a price move here and there, the way you hold on to runs is knowing this logic like what I'm showing you here today. When you see price action with this perspective, and stop trying to make gimmicks, stop looking for these little things so you can sell courses, just simply do this. I promise you, you will be so much more at ease and pleased with yourself because you can really do something beyond 20 handles, 10 handles, 30 handles on a luck. It just starts to capitulate and run. You might get 40 or 50 handles, but you really didn't have an idea that it was going to go there. You were just hoping it's going to go there. I don't trade like that. I don't look at the market and say, I hope it does. If I say hope ever while I'm in a trade, I'm closing the trade. Because what I've said indirectly is I have completely lost connection to what the market's doing. And if you get good at this, you ever start talking like that, where I hope, well, I hope it doesn't. If you start doing that, get out of the trade. You have my permission to kill the trade and take whatever profit you have there and just be done. That will serve you so well in the beginning until you get greater conviction of how to wrestle out these trades that's going to move longer for you. There's nothing wrong with being a buyer here and getting out just above that high. That's where Caleb needs to start. He needs to start with those little runs like that. And then once he does it, he watches the rest of the day. And he'll feel that tug of war of like, I wish I would have held on to it. Well, how can you hold on to it unless you have sound logic to lean on, like that training wheel analogy I gave the other day on the community post? When you're learning how to ride a bike, it's a gradual process to do it safely. And then when you have one training wheel, that's like this, getting along in here or here, and then getting a run to that. And once you see that, be satisfied that you were able to do that. And you have to stop and then watch, observe. And then later on, you do trades like getting in here or adding to it there, taking a partial here, and then waiting for that breaker to give you the next leg up. And then when it takes out that high there, right there, you take the partial that you had running or whatever remaining portion of the trade off, and you close it. And that's how you back test. You look at trades like that every move, and you can do multiple studies and case studies on old singular price runs. There's so many trades in this whole thing here. So many of them. There's literally like 20 different trades in here that you could be doing using what I taught. And you don't even realize that yet. All I need you to do is start with one thing, Caleb, the first start of the run. That gives you your first foothold. It gives you your first foundational understanding of what price is going to do. And then over time, you'll start seeing these things where it runs up here. And then it accumulates again here. It goes into that big gravitational pull that the new week opening gap and new day opening gap being clustered like that is going to present. Then it gets above it, comes back down after accumulating, going sideways, and sends it higher again. How many times, if you've been trading for 2, 3, 5 years, you get a move, maybe you caught something here, and you made a little bit of money. And you're like, man, I had a really good morning. And then you go back and look at the charts because you've been doing something else. You went golfing, wasted your time. And you came back and you see the market's up here, and you're like, oh, man, I wish I would have. When you say I wish I would have, you know what that means? That's the perfect opportunity for you to go through price action and mark it all up, screenshot it to death, annotate it, and talk in your annotations like you really expected to see it do what you see it doing in old price action. What you're doing is you're tricking your mind with self-talk. Technically, you're lying to yourself, admittedly, but you're encouraging yourself like a cheerleader. You're your best cheerleader. And you're teaching yourself to see it, just like when you have a hunter or your dad takes you out into the woods and says, look in the snow, son. What is that right there? I don't know. It's something. Something obviously walked there. He goes, well, that's a deer print, or that's a raccoon print, or it's a rabbit trail. Okay. And you're learning that by observation and doing it every weekend in hunting season. You're learning how to see those tracks. Well, when you're back testing, you're looking for these things, and then you're going to communicate like your dad tells you. That right there is a rabbit trail. That is a deer trail. That's what we're out here looking for, son. So what did he just do? This is what you look for on the ground. There's other footprints, but I'm teaching you to have the affinity, the intention is drawn to a deer track, because that's what's going to be in our refrigerator this winter. We're going to eat that. We're not interested in cooking a rabbit. We're not interested in looking at a raccoon. And it might be a dog print or a cat print from the neighbor down the road in the farm. But here, this is what we're looking for. This is the deer print. That's what your back testing does. It finds the opportunities for you to see the thing that you're going to be drawn to. What are you hunting? Are you hunting order blocks? Are you hunting fair value gaps? Are you looking for fair value gaps that you want to see invert? Are you looking for breakers? Are you looking for institutional order flow entry drills? Are you simply trying to trade optimal trade entries? Are you looking for the fair value gap after 10 o'clock and take as a turtle soup? That's this one right here. Bam. You have to go back and study them, screenshot them, and then say, I was pleased to see how the price behaved at this fair value gap. And it's nice to see how it runs this much and show how many it moves in terms of points, how long it took to get into the middle consequent encroachment of that new week opening gap. You don't need it to be the high end or just the low of the new week opening gap. How long did it take it from that candle there where it bridged into and allowed it to wick through? How long did it take candle-wise? How much of a drawdown in handles, points, if you will, did it have in against you before it traded there? And you log that and you use language like, it excites me to see these opportunities repeating all the time. And I am pleased that I can see this. You may not have watched it live. You may not have done that. But what you're doing is you're writing it out. You're feeding your psyche. You're feeding your subconscious positive self-talk. You're reinforcing something so that way it activates your reticular activating system. And what that means is it's the same event that takes place when you buy a car or you buy something. You might buy a dress, ladies. My wife has done this before. We go out and we go to some event, and then she'll see someone that has what she either owns or what she might be wearing. And gentlemen, it's usually you buy a motorcycle, you buy a car, a truck, or a toy. Okay. And it's a very specific thing. It's a model of a car or truck, and it's a color, and it's got the same trim and everything. And then you go out, you leave the dealership, you're driving down the road, and all of a sudden you're leaving wherever you just got lunch and you feel like a big shot. And you look down the road, and what's coming? Your car. And now you don't feel like so exclusive anymore. But your eye jumps to it. Out of all the cars, you have that moment when I was teaching. If you take a bunch of red apples and you have one green apple, throw it up in the air, your eye is going to go to the green apple, but you're going to be distracted with all the other cars. You don't care so much about that green apple unless it's your green apple. If you had the green apple taken from you, or you lent that green apple to that experiment, your eye is going to easily jump to that green apple because you're activating that particular activating system. You have an interest in it. That's what's happening. So when you're back testing, what you're building subconsciously is with your journal, you're sweet talking. It's pillow talk. You're literally falling in love with yourself, seeing something that's already happened. And that's the same thing that happens when a young man follows his father into the woods and he's looking down in the snow and his dad's saying, this is a rabbit trail, this is a dog print, this is a raccoon trail, this is what we're looking for, son. Well, I want to impress my dad. I want to please my dad. So I'm going to spend a lot more attention focusing on what the details of that footprint of that deer looks like. Because when he asks me again, I want to make him proud. And he tells me, well done, son. So you're activating your reticular activating system by looking at old price data. And then in the annotations in your chart, you're filling that up with positive sweet talk, like you really saw it happen. And then when you, at the end of the weekend, okay, on a Saturday or Sunday, when the markets are not trading and you're completely detoxing yourself, saying, okay, what did I do this week that I did right? And really congratulate yourself, really cheerlead yourself there. And then anything you didn't do right, present that as an opportunity. I'm glad I had the opportunity to study this more in depth because I feel like once I get this under grasp, I'm going to be that much better as a trader. You see how empowering that is? Versus, yeah, I messed up, I didn't do this and I didn't do that, and you beat yourself up. Your subconscious retains that. And you wonder why you feel self-conscious. You feel like you're not confident enough. You feel like you're not going to be able to do it because you're telling yourself. And there's no better critic, no stronger critic, no bigger troll than yourself. When you're really honest with yourself, when you know something, nobody else is going to tell you otherwise. You're on it. Ain't nobody going to tell me anything about me. I know what I can do. Nobody going to tell me I can't do this, you can't do that. You're not doing it on a live account. You're not doing this, you're not doing that. Listen, who's out here telling you? I'm doing it. When you, in subtle ways all day long, tell yourself, reinforce yourself that you're not good enough, that you're never going to learn it, those people are probably right. Why bother? I ain't going to try. Yeah, he probably is a scammer. Oh, he's probably this, he's probably that. You're making excuses for why you don't want to do it. Now, if you go into your journal and you're supercharging your subconscious and telling yourself with positive self-talk, positive self-talk is the most powerful thing a human person can use to manage their emotions and the psychological impacts of stress. It's your perception that many times is what you're afraid of. Because there's so many what-if things in the world and in trading that you're going to scare yourself right out of the opportunity of being successful because what if it doesn't work? Well, instead of thinking that, what if it works way beyond your expectations? What if it takes me 2 years to learn this and 5 years? What if it only takes you less than 1 year? How much more rewarding will it be for you to have gone through the process and you're surprised pleasantly that it took you far less time than you thought? That's how you should be thinking about it. Do not invite other people into your journal. Do not invite other people's opinion of you in your journal. Do not even have conversations about what you're doing while you're learning this. Because no one is going to give you positive self-talk. They're not going to do it. They're going to tell you, even your mother and father might be like, well, be careful, son. Be careful, honey. Don't lose your shirt in that. That right there, that's your mother and your father telling you that. It might be your brother, your sister. You might be your closest friend. Your closest coworker, Carl. Before you understand what he really is doing to you, you might like him. And you fall victim to his crap. Shit talking to you, talking you down, so that way you stay there like a lifer, like him. You're not a lifer. You're not a lifer at your job. That's just a right now, I have to do it, and I have to just eat it right now. But I'm cutting out a pathway that I'm going to be so pleased with And I'm accepting the fact that it's not going to happen overnight. It's not going to be like that. But you have to encourage yourself. And the things that you sweet talk yourself in the journal, making them things that you're looking for, that you can see in hindsight, obviously, you are encouraging yourself with words like, you knew it was going to be there. And it was amazing to see it pan out like this. And then when you read it on the weekend, what happens is you've already sweet talked it and now it's in your subconscious. So you created a memory that's positive. Then when you look at it days later on the weekend, which is what you should be doing every single day on a Saturday or Sunday, you're not looking for trade setups. You're reading your journal and looking at printouts and screenshots where you have done this. Now, your brain and your subconscious is going to call on a memory that you've created with positive, feel good, warm and fuzzies. That's what it feels good when you reminisce about your childhood, the good things. Doesn't it feel good when you remember sitting on your grandfather's lap and eating your grandmother's baked cookies and all these really good things around the holidays? Doesn't it feel good? Why? Why does it feel good? Because it meant something to you and you retained it with subconscious reflections that, wow, this is really fun. This tasted really good. I love the company of this person. Contrast that with a bad relationship that you're no longer a part of. Just to hear their name. Ugh, I don't even want to hear about it. Because you have done what? You have reinforced that thing, that moment, that person, that event in the past with toxicity, negative. So you want to filter all that stuff out of your journaling. You want to filter all that stuff out of your back testing, and you're sweet talking yourself. You're romancing your future trading self. That's what you're doing. You're romancing yourself. You're saying all the sweet pillow talk, because when you look at it on the weekend and you look back at that same chart, now you have the benefit of true 2020 hindsight with the whole entire range of what the market did. And then you're saying that in your annotation that you're pleased with yourself, that you saw this coming and it panned out exactly like you thought it would. And this is what it delivered in terms of the data. This is how much of a drawdown it incurred. This is how long it took to get to a target. This is where first profit would be. This is how long in handles, the number of handles it took to get there. And you have this and you're telling yourself, this was a good experience. And you do this every single week. What you're feeding yourself subconsciously is you're fortifying your mind. You're building up your mind. And you need that in this because it's so easy for you to distract yourself. It's so easy to talk yourself out of it, scare yourself. And you're never allowing toxicity. Even if there's an opportunity for you where you didn't do something, or if you didn't observe something properly, you say, I have the wonderful opportunity to use this focal point, this new thing that I'm now just starting to learn. I'm excited because once I get this, I'm going to be that much better of a trader. My analysis is going to go through the roof because I will fully understand this part. Are you saying you were stupid and you didn't see that coming and you missed it entirely? No. No. Never, never, never do that. Never do that. Your future trading self is a child right now. Would you ever talk down to your child and discourage them and break their spirit? What kind of parent would you be? Terrible. So your future self is still a child in its development. So you want to nurture that. You want to coddle it and give it protection. Nothing negative, nothing toxic can touch it. You're fostering this perfect future self, this perfect form of you. That's what you're building up. And it's a form of meditation. And it allows you also, when you do have periods of where you just don't feel like you're connecting with the market, stop trading, stop looking at price action. Go back and reflect to your journal. What do you think is going to happen when you read all that stuff? Your subconscious is going to remember it as a memory. What kind of memory? It's a warm and fuzzy memory because I made time to write down these things in my own words and I'm reading my own words. It's my own words. It's not a post by ICT. It's not a rant that ICT is cheerleading me. I wrote this down. This is my words. I did this. And your brain's going to remember that. And it's going to make it even more sweeter. And it's going to be like a medicine for you. It's going to smooth out all that stress and anxiety and say, you know what? I remember this stuff does work. I remember these things do repeat. But when you have a bad moment, a bad day of engaging price, it's just one day, folks. It's just one day that you didn't deliver on the highest output. You weren't firing on all cylinders. You weren't on your A game that day. There's days when I'm going to be like that. There's days when I'm not going to feel good. There's going to be days where I'm tired and I'm not well. And if I make the mistake of going in and trying to be the optimal form of ICT, it's not going to deliver. And when it doesn't, I'm not going to say, oh, well, so and so. It's this is what happened. And I know enough to know that I didn't do what I should have done, which is take myself away from the marketplace or not trade with so much leverage or don't trade that session. Wait till in the afternoon. You see how it's easy to manage all these things that you're worrying about right now. All these scary things or this toxic, I don't know if I'm going to be able to do it. How do I do it? How do I go into this? I'm scared about this. I'm scared about that. You feed yourself subconsciously with your journal. And you literally sweet talk and romance yourself with the opportunities, the things you're supposed to be studying. You write in your journal, in the chart, that it was amazing to see this deliver like this. I'm so pumped up that I know that this stuff repeats. Think about it. What would you tell your son if he wanted to be a baseball player and he's going to join the baseball team in your area? You're going to tell him, oh, man, listen, you're not going to be a Yankee, okay? You're not going to be in the World Series. Come on, just get out there and cut the grass and be glad that I'm letting you do it, okay? You're not going to do stuff like that. You're like, you know what, son? That's going to be awesome. I can't wait to see you play. And then you're going to do what? You're going to do everything you can to make sure you watch him at his first time at the batting plate. And the first time he runs the first place, and he's going to look over at you because he wants to see you being proud of him. That's what you're doing with your future self. That's exactly what you do in your journal. You want to know how to journal? That's how you journal. That's what you're doing with it. You are coddling yourself. You're reminding yourself that you're worth it, that you're worth the time and the investment that you're putting into this. Even though it's free, even though you're not paying any money, it's costing you a lot because you're wrestling with the fear and the anxiety and the concerns that you're not going to be successful with it. So you have to constantly feed yourself. And then over time, you're going to see the benefits of doing it. You won't feel it right away. 2 months, 3 months into it, you're going to be like, yeah, I feel the change. Like I feel it. Like I feel I'm not worrying about the toxic things I was worrying about. I do absolutely see these things repeating. So now you have hard data in your hands and you have reinforced it with memory. You've created a pseudo memory of something that you may not have saw real time, but you're going to say you saw it in the journal real time. And your brain retains that as a positive memory. And then when you refer back to it days later, what are you calling on? Subconsciously, you're calling on a memory that has all the warm and fuzzies, which makes it wonderful. So now what does that do for you when you start looking at real-time price action? It's the same effect when you buy that car. You've made something important to you. You have a real interest that you have drawn close to your heart. You love your car. You've been waiting for this car. You couldn't wait to get it. Couldn't wait for them to bring it out of the showroom. It's all waxed and pretty for you. Gas tank's full. Here's the keys to your new ride, your new whip. And you can't wait to be seen by everybody driving around. Well, when you look at charts and now you see something that you've been telling yourself is a good thing, this is a good memory, your subconscious says, oh yeah, that's that thing we look at, we love. It's the same thing your brain's doing when your reticular activating system is keyed up on your car that you just bought. That's why you see them. Every car that's like yours, your eye will jump to every car all around you. Your eye goes right to that one. That's the same thing that's going to happen in your trading. Your price action skills will jump right to that fair value gap that you're looking for. Just like you're going to see that deer track when you walk up on it and you please your dad and say, Dad, look at the deer track. It's right there. Well done, son. I'm proud of you, boy. That's what I'm talking about. That's what you do with yourself in your journaling. And if you treat your investment study time, back testing, forward testing, you continuously do that, you will never, ever run out of motivation to do this. And you will weather whatever length of time it requires. And you no longer worry about how long it's going to take for you to get good at it because it's become a lifestyle. See, you want to trade profitably and consistently. But you don't really want the lifestyle. You want it easily just dropped in your lap, and it can't work that way. You have to adopt the lifestyle first. Submitting to the things that traders that make money consistently, they do these things. They manage their fears. They manage their greed. They manage the defeats they have in being stopped out and having losing days. How do they do that? What I'm doing here. Nobody teaches it like this. I had to formulate this stuff and take lessons I learned from overcoming anxiety and agoraphobia. And I said, you know what? This stuff literally will work for me in trading. And it did. And everybody I taught it to has always said the same thing. This is amazing. Like, I have so much more grasp on my daily routines. I don't have panic attacks anymore. I don't have anxiety attacks. They have stress. Everybody has stress. I have stress. I'm loaded. I don't have to do anything. I could just stop doing everything and sit still and I'm okay. I don't care. I'm good. I'm not bragging. I'm just saying, but I still have stress. In this world, we're going to have tribulation. We're going to have problems and troubles. All of us are going to have that stuff. But how you relate to that and respond to that is going to determine how well you live. How successful are you? You can be very, very wealthy and constantly ate up with anxiety and stress and just be a miserable person. All of this might be the very crutch that you need to get out of your depression, to get out of your low self-esteem, and also your loneliness. You may not be able to meet someone perfectly for you because you harbor all of these self-defeating attributes about yourself. Low self-esteem, you're depressed, why bother? I'm not going to dress myself up and look nice and go in public. I'm not just loaf and just be, be thankful I'm wearing pants today. I'm in the grocery store getting my groceries. You're going to care more about yourself. You're going to carry yourself differently because your sense of self-worth goes through the roof when you start seeing these things prove to yourself that you are not required to be an economic and financial giant or intellectual giant either. But you do have to fix your broken self. And everybody has something broken in them. And the way you fix that is you self-talk. Self-talk is telling yourself, I did this well today. I'm pleased that I was able to have the courage to kill and do it. Even though I didn't want to do it in the beginning, I'm glad I pressed into it and did it. I'm glad I watched that entire video and I got to that point or part of it where he gave me something that really made an impact on me. I could have turned that video off and said, yeah, I'm not really getting anything from this. But now you have something that supercharges your learning, supercharge your personal time in everything you do, not just trading. And it manages your expectations. It manages your emotions, the psychological effects of the stress that you're going to feel doing this while learning how to do it. It's replaced with cheerleading yourself. Everything's a positive. Everything's a positive, and you're never retaining anything as a negative. Anything that's not done right is an opportunity for you to dig into it and learn more and be better because of it. Think about that. That in and of itself changed it for me. When I would lose, or if I felt like I wasn't learning how to do something fast enough or at all, when I changed my perspective to now, I am excited because it didn't work the first time I tried using it. But I am so keyed up on wanting to be able to use this. I believe in it. I believe it's possible. That's the reason why I hammer with this algorithm. That's the reason why I do it. Because so many of you are going to throw in the towel because you think that makes me a fraud because there can't be an algorithm. So therefore, everything I say is fraudulent and it couldn't be true. So don't even bother wasting any time. Anybody that leaves comments says, yeah, I wasted years trading ICT concepts. No, you didn't. You wasted years not doing it right. That's what you did. Everybody heard the same lectures. And I had profitable students. And the ones that did find profitability, they journaled. They didn't beat themselves up and they didn't want overnight success. And everybody that complains and cries about it, they want immediate payout. They want immediate success. They want to quit their job and walk around like a social media celebrity. And I'm telling you, that's not what I can enjoy all the fruits of doing that kind of stuff. And I don't. Because I know enough that doesn't do anything but draw you down. Stay humble. I play a role online. I play an arrogant prick. I do that because it's shocking and it gets people to come here and watch my stuff. That's not who I am. That's genuinely not who I am. I don't take any crap off of anybody, but that's like my WWF wrestler personification. Like I'm Stone Cold Steve Austin, basically. That's how I walk around in the trading industry. But I'm the nicest, sweetest guy, and I'm probably not going to talk much if we were around each other. It takes a lot for me to open up. And you wouldn't think that because I talk. I have a mouth. I just keep talking because I'm comfortable in this element because you're not sitting next to me. I don't know who you are if you're sitting next to me, so I'm not going to feel comfortable talking to you. But I went through the same process, and I fixed a lot of things that were broken inside of me that allowed me to stick to this, to be able to see these things and learn what I had to do to overcome them. And I'm confident that if you apply this strategy in your journaling, it'll fix most, not all, but it'll fix most of your psychological barriers, the fear, the low self-esteem. You'll have the data to support that it's worthwhile for you to continue. And that's a really important thing. Because Caleb, I'm sure he could talk himself right out of this and say, well, I'll just slow down and dad will just get frustrated and he'll just accept the fact that it's not for me. It'd be easy for him to do that. I don't want him to do that, but that's how it would work for him because he's my son. But for you, you're not my child. You're not related to me. And it's easy. You just don't watch any more videos. You don't study the information anymore. And you just only look at the market or quit entirely or go do something else. And to make yourself feel better about the decision, you'll talk shit about me. And that's what everybody else does. And those people aren't successful. So why would you listen to their opinion? How about listening to the people that use the information, did everything I said right, and they're proving they're making money? They're not watching me for trades. They're doing their own trades. So what is it that they're doing differently? They're doing what I taught. They did it properly. If I didn't have anybody profitable, then everybody had a case against me and say, yeah, this guy's fraudulent. He can't teach anybody how to do it, and it doesn't work. Therefore, there it is. But look whose logos on YouTube everywhere. Look what everybody's trying to do. And look at how all these people are getting payouts in funded account companies, how many people are proven with broker statements. It's everywhere. You have no excuse not to be excited about it. And you're not being expected to pay me, and it's my stuff. It's mine. And I'm not demanding you pay me for it. I was shocked that Caleb was even making it where you guys would listen to this. Like, these are lectures and lessons I had no intentions of teaching anybody, even private mentorship students. And they're buzzing like you are too, because they're like, man, this is amazing. Like, this is amazing. Like, it's all clicking for me. Right. Yep. Because this is the market. This is the market. And you need to encourage yourself. And the way you do that is through your journal. So I want to quickly go into well, we're in NASDAQ right now. So let's go into this. I'm going to take this off because if I don't, it'll still be on the chart later on and it'll be bothering me. And I don't need this. I'm going to just quickly review the trade in ES and then quickly review the NASDAQ first. And I'm going to close the video or the live stream. Give me a second. If you've liked what you've heard today, I know a lot of people gave a lot of feedback yesterday. I took the opportunity for you to thumbs up the video just to prove I don't need it. Even if it's not up there, I can still see the thumbs up on the, which I don't ever see the thumbs down, but there's some thumbs down because it's not 100% liked, which to me is always fascinating. I love that because that means there's somebody out there that just is in denial. And as long as there's people out there in denial, that means there's going to be liquidity. They're going to be on the other side of your trade, and be thankful for that. All right, so we are looking at the NASDAQ, and this was done with a demo account. So that way you can see that I'm sticking to my, we don't need to see that, do we? It's just executions. All right, so I was talking to my private mentorship students this morning on Telegram, and some of them, you know, they're paid students and whatnot. Some of them, it's usually the 2021 group that does this. The older students don't really think this way, but the last group I took in was one of the largest groups I had. Like, it was a lot of people, and a lot of them didn't complete it because other people were leaking it, and they thought that they would get the same exposure and lessons by getting it that way. And those same individuals eventually reached out to me in email saying, can I rejoin? And you can't rejoin. Okay, it's over. I'm never doing another one. And the people that made themselves into that group for that particular user group that are charter members, I talk to them and I keep engagements open. I do not call markets live for them like this. I'll point to watch this level, note that level. But I don't do it every day. And then like this morning, I shared this trade here, and one of the 2021 students was like, "Why didn't you tell us? Why show it afterwards?" And when I get stuff like that, I lose interest in that user group, and I want them to feel what it's like, because that's not the mindset that they should have. The mindset should be, oh, he gave me something that he executed on. Let me go in and study it. I'm not showing you something. I'm not showing you executions for the sake of, wow, look at me, because I've been upfront and told you I'm teaching through the medium of what? A paper trading account, because I'm not a licensed financial advisor. So I have to protect myself. And if this was a live account, nothing is different. It just means it's taxable income. This is not a large trade position. 10 contracts is not a lot, or 12 contracts is not a lot. I know what I'm doing. I know how to do it clearly. And it's important for you, if you struggle with this, if you struggle with this part, okay, you can't be taught by me. Because that's going to be in the forefront of your mind the whole time. Instead of saying the proper mature perspective is, okay, clearly this was done in live market conditions, because you can watch what I shared in the recording, that this little area up here, I'm highlighting it, showing it's the market open. Okay. If I do a market replay, if I click anything up here, market replay, look what happens to that green dot. It goes away. You see that right here? It's no longer a green dot. You certainly can't click on it and it says market open. What is it doing? It says replay mode. I don't teach with replay. I don't take trades with replay. I don't do that. Look what else happens down here at the bottom of the screen. You see that? See these? This is like the play, rewind stuff and how fast you can do it. That's not what I'm doing here. So when I'm executing under the premise that it's viewable for you to see that this was a real execution over live data. If the things I'm teaching you don't hold up in a demo, they sure as fuck aren't going to hold up in a live setup or a live trading account, right? So right away, you have the easy litmus test. If the things I'm teaching can't be replicated, and I'm doing it, I'm doing this for free, folks. I have things I could absolutely be doing with my personal time, not spoon feeding you stuff that you actually don't even deserve. Like, you don't deserve this. I'm not out here, selling courses to you when I could be making millions of dollars doing that again. I could be making millions of dollars doing mentorship. I could literally be doing this for big, big money. But you're sitting here with your head up your ass thinking, oh, he only does it in demo. Find somebody else that can do it equally as well as me, explaining it, the detail, using what I've taught here. They won't be able to do it. They will not be able to do it. They'll have a little bit here, a little bit there, but they will not be able to have the precision I'm showing you. And I'm showing you examples this way because I want you to go in and study them. They're perfect opportunities. It was good enough for me to take the trade on, so therefore it's good enough for you to dig into it and see what the repeating phenomenons are, right? So let's dig into it. If you think differently, don't leave a comment, because every time you leave a comment like that, I just broom you. I never see any of your comments ever again. But you think you're over there, saying something I'm worrying about. I'm not worrying about it. Like, I don't hide it. I literally don't hide it because I have legal constraints that in the United States, I have to do these types of things. But you're a moron and you're in another country and you're talking to me about, oh, you don't do this, you don't do that. Get the fuck out of here, dude. Like, I'm literally saying this stuff's going to happen over live data. How many times am I getting it wrong? Hello. So the logic was this. I shared a chart with my private mentorship students, and I told them also to look at Monday's low. That was another thing for the commentary on this morning before we started even streaming. I like getting in real early in the day if the market is providing me a means to engage it, okay? So when I do things before 7 o'clock, I'm not trying to teach you not to follow the rules that I'm laying down. I'm just executing for the sake of you going in and studying because it's price action. Price action is the same thing. The things that it's doing right here is the same things it's going to do at 7 o'clock, at 8 o'clock, at 9 o'clock, at 10 o'clock, at 1, at 2, at 3. It's going to repeat. It's going to do the same type of thing in London. When I teach you specific time frames, like start looking at the market at 7 o'clock in the morning. Don't worry about anything before 7 o'clock. I'm not trying to hide these things from you and then come back and say, ha ha ha, I'm superior. Look, I'm executing before. I'm just giving you something that I'm going to be live streaming. I live stream every day now. And I'm giving you something to study. I'm giving you more things to work with to make it better for you. If you don't like me showing these examples collectively in the comment section, I'll see it. You send me a wave of don't do these anymore. We're not learning anything from it. If the entirety of the community as a whole comes back and says, these are not helpful to you, it's nothing. I can stop. It's not a big deal. I don't need to do these things. I don't need to. But it's usually 2 or 3 people every single time I put up an execution video. And it's always in demo. You're broomed. You're a clown. Like, you're never going to learn how to do it because you're worried about the least important factor. Go up there on the playlist and look at the TD Ameritrade account. I log in, you'll see 3 months of every single trading day. Every single trading day. And I was answering questions with students that would say, what happens if it's like this? And I said, well, I'll show you in a live account. And I used live market conditions with real money, and I doubled the account in 5 weeks with having 30% intended drawdown. One of the ladies are asking, hey, what happens if you're in 20% drawdown? How would you do that? Okay, this is how I'm going to do it. There it is, done. One contract. Not 20, over 20 contracts, over linked accounts. One. Using full margin. TD Ameritrade doesn't give you discount margins. Okay, so when you look at that Robinson account leaderboard and it's a couple 100%, it don't take me long to get what's up there. None of that is even worrisome. None of that's worrisome. You just sit back and relax, okay? But the point is, if you're worried about this being just demo and you're not appreciating, understanding that the fact that I'm in dangerous waters if I'm out here claiming that you're going to make millions of dollars if you do what I'm doing. I can't make that claim. I can't make that claim even though I'm teaching for free. I can't make that claim, and I don't make that claim. I always promise, and I always beat my chest and say, my concepts will mop the floor with everything else out there. And once you learn how to do this, you will read price better than anything else out there will do for you. And I will stand in front of anybody, any court, say it, prove it with people that I have as students that are doing it. And I'll do it like I do right here in front of you. Call every 1 minute candle before it happens. Like, I ain't got no problem with it. I'm out here doing it live. If I thought that I couldn't do it, if I was scared, like this is somehow going to stop working, I wouldn't be out here explaining it live. But that's a weak-minded person that just simply will not do what's required to learn how to do it. They'll always be in people's comment sections, and they'll still be working a job that ain't making them enough money. That's what's going to happen. That's the other side of this. So what I was talking to you earlier, how to build yourself up, fortify your subconscious, and feed yourself to all the right things, that's what encourages you to keep going forward. And it's a matter of sticking to a process, okay? And when I give you trade examples, it's showing you, because I can show you something in replay. I can be what everybody else does. And to me, I can't live with myself like that. I can't live with myself like that. I can't. So I have to execute over real time. I have to do that. Number one, it's easy for me to do it. 2, it is a reward for your time spending with me that, yeah, I can do this. So if Michael can do it and he's using the same rules he's teaching, I'm watching price action, using this content, I should use these as mile markers. Can I eventually get to that point where I'm taking these? Because these are easy trades. These are not high technical trades. These are very easy bread and butter type setups. These happen every single day. You don't even need to trade with a bias. Like they're just real easy. And I'm not trying to say, look, this is the model for Caleb. This is Caleb's model. No, this is just for you to study I'm not pushing you into a one mold. This whole entire YouTube channel, that's the premise of it. I'm showing you all of the opportunities that are there for you, which makes sense for you. And when you figure what that is for yourself, don't worry about anything else I'm doing. That's the mature mindset. Okay, well, yeah, I'm trading optimal trade entry. I get it. All the stuff's fascinating. It's neat, but I have something that's making me money. I make money with this ICT, so I'm not trying to break it or make changes to it. That's a mature mindset. That's what I want my students all have. That when you get your model, you don't care what I'm doing. You don't care if I teach anything else in the future. You don't care. You might watch it, but it ain't changing what you're doing because what you have works. Find that in your mentors. They're not going to tell you that. They're going to be trying to sell you the next thing, the next course, the next little gimmick. I'm not trying to do that. I'm giving you the proper framework for you to develop. And if I can't show you examples, that means that I don't know what I'm doing. If it can't be done over live feed, live data, then it doesn't hold water. So you can clearly see that that green dot is in the recordings. The bottom of the screen, it shows the time. I gave the entire recording with no change in the speed. So that way you can see it's not sped up. I didn't hide anything. It is what it is. The second one, I didn't do any audio in it because, as you heard in the first one, my puppies were really hyper this morning. They're jumping all around, squeaking their little ball toys and stuff. But if you look at what we have here, we have a new day opening gap. And one of the comments that was left by one of the gentlemen said, we can use a new day opening gap older than 5 days. I've commented on that. Okay, but for Caleb to give him a foundation, and for you for a couple of weeks, maybe a month or two, only focus on the ones that are within the last 5 days and the last 5 weeks for new week opening gaps. Okay, you have to take notes. If you just listen to me and you have selective hearing, you're not learning. You're not trying to learn right. Okay, and if you're asking, and I have a lot of people in the comment section asking questions I've already addressed in the very video they're leaving a comment on. So that right there indicates that you're lazy and I broom you. I delete your channel. You can't, well, not delete it, but it's called hide user from channel. That means I'm never going to see your comment. I'm never going to hear that ever again from you because you're telling me that you're lazy, you're not willing to take notes, and you're not willing to listen. If you're not willing to listen, you aren't a student of mine. You need to go somewhere else. And I wish you luck at it. Whatever you do, I hope you're finding success in it. But I don't have time to have those type of people use up my bandwidth and attention. If I'm going through the comment section, I look through them, and if I see something that is a wave of the similar type of question, then okay, that's a real good area for me to talk about when I get into the next one. Or I'll go in and look for setups that give me that reason to talk about it. And that's why I talk so much, because I have a lot of people asking about a specific thing, and then I'll address it. I'll talk about it, and I'll find ways to ring into it with real-time price action, so it kind of addresses it over real-time price action. So you can see how it fits, how it's germane to the discussion, and how I think and feel about it based over real-time price action. And you can't get a better way of teaching than that. Like it's engaging, it's real, and it's over real-time price action. Like I have to draw on the things I've already taught here, unless it's something new. But now you get something new, those rules are not changing. And when people say, I disagree with your classification of that being a fair value gap, it didn't send price lower. It didn't send price lower. So the characteristics you're trying to attribute to it, you're incorrect. If I make a mistake, I can come back and say I made a mistake. I've done that before. But when I'm classifying the PD arrays, they're what they are. And I'm giving the details as to why. And you'll see the logic is not changing. Modus, okay, and a Reaper are not the same thing. There's certain things that are taking place, and they may do something slightly different, and the weak-minded, the lazy, are going to say, oh, well, it's just a fair value gap. And then you're going to think it's going to behave a certain way, and it won't. And then you're going to say, well, this stuff doesn't work. Like the Tom, Dick, and Harry's over here in other people's YouTube channels leaving comments and circle jerking each other. If you don't want to learn the logic, that's your business. But to learn the logic, I do executions, so that way you can go in and say, okay, this is something that a button was pushed Time was spent on it. A stop loss was placed. We can exercise understanding by going in and back testing it. Really strip it down and see what was in the charts at the time. And if you look at what we have, the time of day here and the next one's here. Okay, so what I'm watching is we had already traded up into this volume imbalance there. We went lower, and then we went one more time, bumped it. And remember I was telling you earlier that the bodies of the candles can go just a little bit outside of the PD array. The high of that PD array is this candle's close. Let me move this down here like this. This price right here, watch that, okay? 19,598.25. So when we went above it here with this candle's close, the fact that it did that, it's so subtle that it's permissible. I allow that to happen and not change anything that I expect in price action. Because it's like your child that colors in the coloring book. It could go outside the lines and you still are proud of that child's work. So when my algorithm is behaving like this, I am not looking at price and saying, oh, well, you know, it's broken or they changed it. They didn't change anything. It's doing everything it's normally going to do. And the next candle confirms it because it stays where? Inside of that volume imbalance. So the market shows a willingness to go lower. So we had stops taken here. The market drops. And then right in here, what is this? If this run up takes out the liquidity and this gap with this volume imbalance, anyone else that doesn't know really what's going on, they may look at that and say, oh, this is a buy, and then look for it to go higher. I do this. I have people also yelling at me in the comment section. Dude, you waste so much time doing this. If you would just do what? Do what? Do this. Do these over here. I got them already, folks. Okay, I already have that. I do this because new students are going to come here all the time. And they want to ask me questions. How do you change the color of this? And how do you change the color of that? So I literally walk through it because I'm an educator. Okay. I'm not dollar mentorships. Okay. I'm not 5-minute trainers. I do things the old school way. I want you to learn it properly. So I draw out everything like I want you to do in the beginning. If you want to make things to shortcut everything for you, that's wonderful. I'm going to maximize this. Before I do it, let me show you again. Look real close for the people that get their asshole hurt about this. Okay. See that? Right there. It says paper trading, so that way you can go on the internet and talk about me. But I want somebody else that talks about me to do it with the paper trading account. Be this accurate about it and that consistent with it. So you can see that we have this inefficiency that's overlapped. I love the fact that when we drop down and we had this little wick, that little wick right there is a mohawk. So whenever you see that on your chart, when you're annotating and back testing, this is how you should properly annotate that. This is what I refer to as a mohawk. And a mohawk is just where price has been allowed and you as the analyst afford it to behave in a certain manner that is just outside of what would be perfect. Perfect would be to stop at right at that candle's open because there's a volume imbalance. Whenever you have a volume imbalance that's part of a buy side imbalance or sell side inefficiency, you cannot just use the low of the wick. You got to use the volume imbalance. That's the true range of that inefficiency. Because you have technically you have two PD arrays agreeing with the same context of price being offered what? Strongly with buy side, inefficient in sell side. That means it's got to offer this type of price action where it's dropping down over that same range between this candle's high and this candle's open, which is the volume imbalance. So we have now two deliveries, up and down. And then we have this. One more attempt to do something above it, and it wicks. See that? It wicks. That little tiny coloring outside the lines of that volume imbalance high, that right there and where we close with the bodies tells me that this should drop lower. The next candle we open drops lower. One more time to consequent encroachment. We break lower. We create an order block. This order block is part of this one. What kind of order block would this be? If you went through the core content in 2016, I believe it's month 4's content. You can find that on the playlist on my YouTube channel for free. I go through all of the PD arrays that I was willing to teach at that time. Obviously, I've taught new ones, but the ones that are in core content, I teach the propulsion block. So we have order block that reaches the high end of the inefficiency over here. There, it drops. This one here, this candle's body cannot breach half of the order block that it's traded back into. When you get that, it's kind of like a tipping of the hand. It says, we have an order block that should send price lower, and then there's another one that's digging into that previous order block. So you're really getting a lot of conviction placed around the idea that prices should be repelling away from this one and certainly away from this one. But we have this order block forming inside of a inefficiency. And the consequent encroachment of that inefficiency is right here. See that? So I'm going to take the execution off just for a sec because they're in the way, and I'll put them back on when it's done for the talking points of this part. So we wick up into, I was using this order block as my initial entry. You'll see it when I put the executions back on. I'll put my cursor so you can see where those entries were. And then as the live stream occurred, as we went into consequent encroachment of this wick, as soon as we hit half of that right there, I went in on that candle. I'll take that too. I'm not afraid that it might go higher. Why am I not afraid? Because I have an inefficiency here that has changed into an inversion. This is a little coloring outside lines. Could it hold on to that? No. And then we closed here, not at the high of the fair value gap, near the metal. And then the next one we do what? We confirm it. We open, trade outside of it. So what is it done here on that candle? What has it done? It's left this gap energetically, and look how it closed. So that means we can still trade up to consequent encroachment of this inefficiency because that's normal. That's normal. And it could be normal through the lens of the wick doing it only. What do we see here? We open, the body goes all the way up here, stops just by a little bit. So that little movement above that midpoint of this inefficiency is the same thing I've outlined here. That's a mohawk. So you would do the same thing here. In your journal, you do this. If you don't do these types of things, okay, and I mean this, if you don't log this and recognize these things in your back testing, you're going to fucking freak out when you're watching price action and it's a bold face green candle and you're going to think, oh, it's going to run higher. When you hear me talking about price, how many times am I going, whoa? Or you hear my voice shake, my breathing? You don't hear any of that stuff. This is old hat stuff because I've been doing it for such a long time. You're going to have that same bored approach to watching price eventually turning into real-time trades because you've seen it so many times. It's normal. But when it's a bold-faced bullish candle and it's all the way at the highest high, it's going to be terrifying to you in the beginning. You're going to second guess everything. And the market comes down here and closes outside the fair value gap, validating this right here. So this is just returning back to a level that's permissible. Then the market opens, indecisive candle. We want to see it drop away. It does. Now we know that this is a propulsion block. Why? Because its candlestick body did not close above or cross mid part of this candlestick, which is the order block. The rules I'm showing you here, there's very specific rules that's going to be in the book. It's this, well, it's mentioned through all three of them really, because I can't just teach order blocks in one book, but it's spread out over the trilogy. The propulsion block, its entire range needs to be referred to. And it went just a little bit above halfway point of that inefficiency. Now we're expecting this to be treated as an inversion fair value gap. So while it's not on the chart, these are all the things that my eye is seeing, my brain is seeing, my subconscious is retaining old information, old lecture, old notes, old logic that I've shared. Everything's coming together like a perfect storm. And I'm seeing all these things immediately when I'm looking at price. And it sounds like you're never going to get like to this, because it seems like a whole lot of complication, and it's not. It's really easy stuff. It's very simple stuff. You just haven't been logging it and seeing it, and then now you're familiar. Think about how it felt when you first started thinking about learning to trade with fair value gaps. You're like, what is a fair value gap? I don't understand it. Is this a fair value gap? No, because the candle crossed over here and touched it. You see, that was just you not knowing something and then spending a little bit of time. Now all of a sudden your eye jumps right to a fair value gap. So this is now inversion fair value gap. So in my objective as a teacher, whenever I have a range like this that's highlighting a fair value gap, if it's ever a hue, it's an orange, what I'm saying is its role has reversed. So whatever it would have been initially expected to deliver over here, dropping down, it should go higher. That's what the myopic view is. But then when it gives up the ghost and leaves it here, and then we get it confirmed there, everything going future, allow for it to trade back up into here, but stay out of what? What should it stay out of? What should price not do? Explore in the upper part. That means this. Let me see if there's a price level I can borrow to make it easy for me. It's going to work like that. All right, let me do it this way. This shaded area here should not be traded to in this inefficiency. We worked the lower half of it. We mohawked above it. But this portion, let me take the halfway off, because that's not essential for this part of the discussion. We had enough confirmation here with a mohawk above the halfway point of that inefficiency. So this is the portion, if it's really valid, if it's very, very strong, if it's going to send price lower, we will be encouraged and we'll know we're on side. That means we're on the right side of the marketplace. If any rallies that can be done with a wick, because the wicks can do what? The damage. That running up into that, we should not be fearful of that. We should be comfortable with it. And my stop loss was above the rejection block, which is the up close in this swing here. We have high, higher high, lower high. The up close, the highest up close in there, go into month 4's content in the 2016 private mentorship playlist on this YouTube channel. Go to month 4 content and you'll see a lecture that talks about rejection blocks. Okay, so I've used the rejection block because it's already worked it here. We traded above that closing price on the next candle. Then it rejected it. We went right up to it here and delivered the same price. It looks like the same price, doesn't it? What's the high of that? 592 3/4, and the close is 592 3/4. So it just tagged it right there. How is that not proving the logic of a rejection block? It needs to be traded to one time, and then if it's good, it should not go back there again. And here it is. It stops dead in its tracks. It never goes above it. See that? And then this little run here, that's why you watch me in the recording. I'm talking as I do this. It's me using this wick. So I measure in the video. And this is, now I'm sharing this logic with you. So that way, every example I show in the future, you're going to see that if I'm using trade formations like this, it's the same logic repeating. I'm not reinventing something. You know, I mean, think about the level of acrobatics that would be required if this was being made up on the fly. Like I've had people when I was on Baby Pips saying, "Oh, this guy's making stuff up." Man, I tell you what, this would be the biggest, amazing orchestration ever in history if it was something being contrived and made up as I went along. But that is consequent encroachment. And as it slammed up into that, I said, "Oh, I'll take that too," trusting that my stop loss is not going to get hit because of the logic I just outlined all here. Now, explain how I can easily just teach that to you in 5 minutes when you have to have an understanding what a rejection block is. You have to understand the run over here on the stops that we're going to reach for this level of liquidity next, and then draw down to a new day opening gap. What is a new day opening gap? Why should this be a run on stops, and why should I even be concerned about this low? And what's this gap here? And what happened? Why are you putting your your fair value gap high here and not on the wick because you showed in one lecture that a fair value gap is on the wick to the wick. But all of these things are evolving. You understand? That's why 5-minute trainers, that's why 19 minutes I'm going to teach you every setup for ICT is never going to be fucking profitable. It's not fruitful. It sells clicks. It gets people's attention, but it's not giving you proper understanding. This is my stuff. And if I'm going to teach it, I'm going to teach it to you correctly. I'm going to take the time because it's my baby. It's mine. My whole life's work. So I'm not going to half-ass it. My whole entire life has been around codifying these very things. I am not going to shortchange it. I am not trying to rush through a video to appease the short-winded people. I can't care any less about those types of people. I want you to stop watching my videos if you think that way. I swear to God, I wish you would never come back to my channel because you're wasting your time. I'm not wasting my time. And the people that are here to learn, they're not wasting their time. They're making fucking money when they learn how to do this. And that's the bottom line. Look and see, the crowd is getting bigger with all the receipts. So as it went up there, as it jammed up there like that, did you hear me go, oh shit, it's going to stop me out. Oh man, it's going to go for my stop. You didn't hear me say that. As soon as it jammed up in there and hit that wick, because I was looking for it, I said, watch this right here. And then, done, I'll take that. Yes, I will have that. That's seconds. I'm hungry. Feed me. I want more. I want more of the good stuff. Where's the good stuff? A run down here. And if I can get lucky enough, and I was getting ready to map out the difference between the, I falsely called it a order block because I'm talking about it live. This low and the new day opening gap on August 16th, I was going to do half of that range and I was going to set up a partial for that. But then all of a sudden it was like, that's a fun problem to have, isn't it? You're like, okay, I'm going to set up a partial, and then bam, it just starts running real good for you. That's a trait that you're going to find that using my signals, not signals, my setups and my framework for your setups and signals that you take as your own trades, that is a hallmark of my stuff. The trades usually are very fast. They are eager to please you. They're eager to scratch that itch. They're eager to move. Go, 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 baby. You ever seen the movie Gone in 60 Seconds? Nick, what's this guy's name? I can't think of his name. He plays Ghost Rider. It'll come to me. At the beginning of they were going to steal all these cars on the list for the black market, and they had the Lowrider song come on. They can't go out and do their job until they play the song. And it's just the beginning of the song. They say, okay, shh, and they're all chilling. And he's jamming to it like that. When I put a trade on, in my mind, that's what's going on. That part of that movie is looping all the time. And then when the run is about to start taking place and start running off, he goes, all right, let's ride. Okay, that's what goes on in my mind. That's like I'm a movie buff. Like everything about me is movie. So I have always made these little annotations in my journal linking things to movies. So in my mind, the dialogue is before the move starts taking place, I'm listening to Lowrider jamming in my head. It's real subtle, but then all of a sudden when I know it's about to take off, it's like it's that scene where he's like, okay, let's ride. And they all disperse and they go after their cars. Well, a fun little bit of business probably doesn't mean anything for you. Probably thinking like this is stuff that doesn't need to be put in the video. You could have taught this in 5 minutes. Go somewhere else. But the fact that it slams up there, real time, go watch the recording this morning. It slams up into it. As soon as it touches the consequent approach from that level, I'm hammering it right at the market, selling more. Now, I'm expecting, because it did this, it should not trade back into this portion of this inefficiency. Okay, so in other words, I don't want to see the upper half traded to. I want it to stay keeping that portion open. Because we had so many qualifiers in here saying that the rejection block has done its job. That's algorithmic. Why did this candlestick stop right there? You're telling me that the sellers just all knew that that high at, what is it? What is that? 19,592 and 3/4. That's this level right here. Well, look at that price. That high, 19,592.75, just happens to be the same price of that closing price, 19,592.75. So everybody's buying and selling pressure just happened to agree to let those values be what they are. And I taught that lecture in December of 2016. That logic has been around since 1996, mine, when I codified it. So the question is how does it keep working like this if it's random buying and selling pressure? Because you can't call the buying and selling pressure anything but random if you're going to assume that that's what makes the markets go up and down. But how is it that the market, you're smiling right now if you're thinking, this son of a bitch, he's cracked it all. No, I wrote it. So when we're looking at how the market drops away from this right here, this rejection block, I'm sorry, this constant encroachment is not going to go back to the rejection block. So I'm not freaking out that my stop's going to get hit. So it's these types of things that you're learning in this mentorship, which is the top tier in technical science. While you're all looking at my trade executions, demo or not, I have live executions with AMP on this YouTube channel. That's a real broker. I have executions using TD Ameritrade, live broker, and I'm using the same logic. And you're all questioning, dude, please teach stop placement. Please teach how you're putting the stop losses where, how I need to get that skill. You're learning it right here. Every single time I lecture and I teach, I'm teaching that. But it's one component that needs to be relying on other things that are supportive. So that's why I'm trying to tell you, anybody that's lying to you and putting on a facade that they're going to somehow shortchange and make it easier for you to learn this, it's impossible to be shortened. There's so many things that have to lean on one another for it to mesh perfectly. Just because that's, inversion fair value gap potentially there, doesn't mean that I'm going to trade it unless I have other things supporting it, like an order block. An order block has to have other things around it. It's not just an up close candle, and it's certainly not just the last up close candle before the down move. You're learning it PhD level, okay? You're literally going to have an understanding about price action that is completely alien to everybody. And I have people in the audience from Goldman Sachs. They're watching just like you're watching, and they're scribbling in their fucking notebooks the same way. Okay. I have had people reach out to me and say, please, we want to have you be a consultant. And the answer is fuck no, I don't want that. This is it. This is how I do things. Okay. This is how I do it. And if you don't like it, kiss my ass. So the market gives me a perfect execution for another pyramided entry. So as it slams into that level right there, I'm confident that it's not going to rejection block, which is this up close candle's closing price. Because everything I've outlined here has fortified and solidified my confidence is valid and I don't need to worry about it. It's not going to my stop. So if it gives me another premium level, which is this one here, because it should not touch the low of that upper half of that inefficiency. Why? Because when it's bearish, the upper half, the premium aspect of that individual PV array, the upper half, once it leaves it, or it assumes that it should not come back there, in my mind, I want to see that area fail to ever be redelivered to. That's exactly what I want. That is not friggin' supply and demand. It's not. Find that in that logic. It's not there. Perfect delivery. Executions. Here's the first one. I'm hammering the opening price right here on the projection block. Propulsion block, rather. The propulsion block, I'm hammering it as it hits it there. And then the next candle gives me even better placement, which is the consequent encroachment of that wick. And right there it is. See it? Look right there. And I'm talking about as I do it. Can you do what I'm showing you here with market replay, with this, doing this? Can you do that? Because if you can, you're hacking something. I'm not hacking shit. I've been accused of hacking stuff in the past. I can't hack. I don't know how to hack. You give me too much fucking credit. But it sounds great, doesn't it? But beautiful placement there. Hits it, falls short of the bottom of that inefficiencies, upper half. And then I want to see price start to get heavy. Start to get real, real heavy. And it breaks lower, digs into here. I was going to do something like this. right there, halfway point. I was going to use that as a partial. So I would have put a limit order taking 3 contracts off of the 12. That would have been there. And the way I would have done that was I got an eyeball of 574 even. If it wouldn't have been so quick dropping in my favor, I'd try to find it over here on the right-hand corner of the price axis. Look over here. As I'm moving, where I'm not touching any candlesticks, I'm moving it around till it goes to 574 even. Once I have it there, I take my hand off of my mouse Surface Pro, and then I right-click, and I go to buy, but the number has to be, if I have the buttons up here. I don't have them up here because I'm not trying to trade. But you got to have the number of contracts that you're going to try to work with. So you would change it to 3 if I was going to take 3 off. But let's just say I want to take 5 off, okay? And I want to take them off. I'm short here 12 because I got 6 here and I have 6 here. As it's breaking below that low, I'm aiming for this old new day opening gap, knowing it probably could go lower, but I want to teach my son what? I want to teach him get the easiest fruit that's hanging lowest. Just grab it. It's easy. It's right there for your taking. Don't complicate it. If he only gets all of his money off at this level here and not to that new day opening gap, how's that a failure? You're making money, more money than most of you people that would be criticizing him, and you probably won't even make that in a month. And he could finally make that in 1 trade, but it's going to take time for him to get to that point. So here's 574, the halfway point. Then you right click on it, and then you would go to buy 5 contracts in this example, because if I pull up the buttons, that's where I had the number of contracts last for it. But you would change it to whatever you want, and then you click on that, and it drops your. You can't see it because I don't have orders highlighted, and then it would appear like that. And as the market would have dropped down here 1 tick below it, that order would have became a market order to buy at market, and then it would fill you at 574 or lower. You might get slippage. It doesn't happen all the time, but a fast market, you might get positive slippage, which means you get out at a better price lower than 574. But 574 is where that limit order would try to execute you at. If it went down to it and didn't fill it and went higher, you never would be getting out there. It would still be sitting here like it is. And then you watch me drag the limit order down into this low-hanging fruit objective of a new day opening gap on August 16th, 2024. And there it is. You saw the trade pan out. And that's happening right here. See it? Right there in midpoint. Right there. That's not market replay. Okay? Market replay has these really ugly, big arrows when you do a market replay trade. I didn't know that until I did it in one of the recordings to prove that I wasn't doing market replay. But I don't need to be teaching this over live data with live executions, because I have communicated a model that is good as it is in demo, it's just as good in live market conditions. Clearly, I don't have a job. I'm spending my time when other people would be working. You're probably watching at your job, and I'm doing this for free. My question is when individuals take the time to sit down and think, I'm going to go on here and criticize him. The only thing I can think of is you think that your stupidity is going to cause me with reverse psychology, like, oh, I got to go out here and prove myself with a live account. That's not going to happen, because I still am met with, if I'm doing this in front of you, okay, and I'm saying, this is a live account, I'm going to put my trade on with this live account. What am I saying? I'm saying, if it's good enough for me to risk real money, hint, hint, nudge, nudge, copy me. That's not going to happen. I'm going to execute, okay? I'm going to execute in front of you. I want you to know that that execution right now is going to be in a demo account for those reasons. If that does not help you, if that doesn't give you confidence to train with me, go somewhere else, okay? Because I'm not opening myself up to liability just to appease 2 or 3 people each time I do a video, because that's really what it is. But I want these individuals to get past that so they can learn how to do it themselves, because they're worrying about those little things, and these little minion perspectives, they're easily spread across like a cancer, because a lot of people come into trading with justified trepidation and scrutiny that everyone should have placed on them. I don't want you to take my word for it. I've said that always since day one. I want you to take what I'm saying and go in and see if these things are appearing in your chart. You don't need me to do anything after that happens, because now you know what you know. It can't be taken away from you. No one can say it didn't happen. And when you're sitting here watching live price action and I'm calling that, explaining it in detail, and it's a repeating phenomenon with a logic that's already been explained, what are you left with? Oh, well, he was honest enough to tell us why he's not doing it with live data and a live execution on real money, because he's not trying to entice other people to do it. Because then I'm stepping in the role as what? A financial advisor. And I am not doing that. I would never do that. But I have no problem pushing a demo trade in front of you. I got no problem doing that. I'm gonna mop the fucking floor with whatever you're used to seeing as a live streamer when they're taking trades. I'm going to smoke the shit out of everybody. Not because I'm trying to be an asshole, not because I'm trying to be mean, but because I want you to see what you can do with this stuff. That you can do with it. And also, these same live streamers that pretend that that stuff doesn't work or that I don't know how to trade, they secretly they're using my stuff. And some of you can recognize it right in their live streams, and they ignore you when you mention it. And it's okay. I don't care. I want them to get better. I want them to do well. I want them to learn how to trade really, really good. Because the people that watch them do it and they're foolish enough to just copycat, at least they'll be copying someone that knows how to trade well. And that's what I'm trying to do. I'm trying to help everybody, because there's a lot of stuff out here that people claim is not real. It's not real. That doesn't make the market go up and down, and they just simply don't know what the hell they're talking about. And they live in market replay. They live in hindsight data. They live in that because it's easy to fleece people that are stupid. And they're stupid because they just don't know any better. When I first started trading, I was stupid. And I thought I was smarter before I really was. Today, I'm a mental giant compared to how I was when I was making money as a 20-year-old. Just because I was making money as a 20-year-old doesn't mean I was smart. I was not smart. I had no idea what I was doing. And I was teaching people before I should have. And that's something that I had learned painfully in the 2000s when we had the market drop aggressively. I was like, man, like my short game isn't as strong as my long game. And I had to increase it and then get really, really good at it. And now I'm not afraid of shorting. Shorting to me many times is a lot more fun because it tends to be a little bit faster when things go. When they go down, they tend to be a lot more sudden and dramatic. And it's because it's a built-in characteristic of the markets. They're really a Ponzi scheme. And Ponzi's are, you go in to build it up. So it's quick to get that down to a discount. Why? Because it's going to lure in more suckers to buy at a cheap price so they can start building that Ponzi back up. So that's why bear markets are always stunning and fast, but they're very short-lived. Bull markets tend to go up for a long, long time. And that is a built-in priming example for people to buy and hold. Buy and hold. So it's a matter of keeping people under the subjection to the ruling class, if you will. Give me a second, I gotta take a drink. I swear, I wish I had somebody like this when I was growing up and learning how to trade. This would have been amazing for me to be a part of. Like, I would love to be where you are at right now in the audience. And that's not me self-loving myself, because it's like fascinating, isn't it? Like when you can see this stuff and it makes sense, it's clear logic. It's something that you can repeat and find setups that repeat over and over again. But what was the other thing I was going to do? ES. No, ES is going to change the chart here. I am starving though. Good grief. I am I'm hungry. What time of day was that? I haven't been messing with the ES for a while. But this was something I showed one of the ladies that were asking me, can I talk a little bit about ES? This is me promoting Patrick Whelan, so you can go to his YouTube channel and give him some clicks. It's not mean-spirited. I actually like Patrick. I just wish he would just settle down and try to learn how to do it better. It's for free, and you ain't got to hide it. Nobody's going to troll you because you openly admit that you're trying to use some of the stuff that you're learning from me. And it's good. It's good that you're learning it. I don't care. It ends up in your course. I don't care. I really don't give a shit. But the point is this. As the market was dropping down, this was Monday's, where's it at here? There we go. Monday, August 26th, 2024, it's daily low. And below that low is sell side. That means there's sell orders. So if we look at it like this, here is Monday, right here. That's the low. So there's a setting you can have, and I'm not going to waste my time trying to fiddle around with it, but I was trying to set up Caleb's trading view where you can highlight the high and the low. I'm not sure if it's set to the highest high and lowest low that's visible on your chart at the time, like if it's dynamic, or if it's a high and a low that shows you previous day's highs and low. If it doesn't do that, there's a lot of indicators I'm sure on TradingView that you can toggle, and it automatically populates on your chart. I'm not a fan of that. I'm a fan of old school. I like the high touch over high tech. I like the fact that I'm going into the chart and I'm finding the low of the day and I'm dropping a horizontal ray on that and I'm highlighting it that way. Because what I'm doing is I'm taking the time to verify that I'm finding the low. I'm not building a dependency on an indicator to plot something for me. To me, it's just so fucking lazy. It's lazy. I like the high touch of doing these types of things. That's why my journals are on archaic leather journals that cost a lot of money, and I don't care about the electronic retrieval because I'm not in a stage of my development that I have to go back and sort through thousands of journal entries by having it on an electronic format. And I don't trust that technology won't get. I have had iPhones before, and I've had recordings of birthday parties, Christmas, very, very wonderful pictures of family members that I no longer have with me in this world that I can't retrieve because Apple sucks. So I will never own another Apple device. And I don't want to store things like that on those types of devices. And anything that I'm journaling, the things that I journal are so important to me. I want to be able to have them physically in my hands, like physically in my hands. So I'm always going to be a proponent of physically handling the things without having all the bells and whistles. Like while things like Lux Algo, I'm sure they watch my videos. I'm sure they're in there because they have a lot of stuff. Um, One of their most popular indicators is all about smart money concepts. My name's not attached to it, and it's whatever it is what it is. But some of the things that that algorithm, or not algorithm, but that Lux Algo indicator is supposed to do is not it's not accurate. And I say that because it's true. It's not everything in there that's being populated on the chart is something that I would use. But it looks technical. It looks like it's giving you stuff that I wouldn't even associate with referring to it at all. And they'll probably have a better form of that indicator once they read the books because all the details I'm willing to share with the public will be there. But I share a lot of it here on the YouTube channel. But the low on Monday, the liquidity below the previous day's lows, the highest high and the lowest low in the last 3 trading days, you have to have that information all the time. You have to have it written down in your little notepad next to your computer, no matter what market you're trading, whether it's forex, whether it's treasury bonds. Um, I'm not going to say anything about crypto because I don't trade crypto. I don't have any experience with crypto. But if you're trading any other market but crypto, the last 3 days, whatever the highest high was and the lowest low, you have to have that information because the market will refer back to that. The previous day's high and the previous day prior to that. So what you're looking for is the highest high and the lowest low in the last 3 days. Then you're looking at the high and the low of the day 3 days ago. It's not the same thing. Listen to what I just said, the highest high and the lowest low. Because you're going to also refer to, like for instance, say today's Tuesday, we're going to look at Monday's highest high, lowest low of the day, or its daily range, high and low. Then you're going to look at Friday's high and low, and then Thursday's high and low, not Sundays. Sundays are treated differently. The only information I pull from Sunday is the opening on the new week opening gap. I don't care about anything else on Sunday. The only importance that you're getting on Sundays, I don't care about the high, I don't care about the low prior to trading into, crossing over to midnight and New York local time. I don't care about that. I'm looking just for the opening gaps that form on Sunday's 6 p.m. opening. That's Forex and that is futures. It's everything. Okay. Apart from that, Sundays are a nothing burger to me. But that's really important information looking at where we open at on a new week because you can take that information that's been proven here, you extend that out in time, and it's useful for weeks and months. And it's alien to people prior to not learning it from me. They have no idea that it's even there. But look how many times there's setups. Look how many setups that form, how many times it gives you a draw on liquidity. These were all things I was hiding from you when I was out there just doing it on Twitter, just trading and just blowing it up. It's literally just over and over and over again. Boom, 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 boom. Smiling to myself thinking, you're never going to get it. You're never going to get it. It's hidden from you because you've never been taught. And that's why no one's been able to say, oh, he got that from so, because everybody's in everybody's book and everybody's course. And there's some old hats in this industry. They're watching me too. And they ain't coming out saying, oh, this guy got it from the so-and-so, right? So main thing is daily highs and lows, the liquidity above and below those reference points. You want to have that in your list of things to observe. They will act as draws on liquidity. The market will gravitate to those, just like a new week opening gap, just like a new day opening gap. So it helps you understand liquidity. It helps you have a steady supply, never running out of setups. You're never going to run out of yeast as a baker, okay? You're never, ever, ever going to be shortchanged on opportunity because there's always going to be a previous day's high and a previous day's low. So I'm going to teach you the basic elements of what I was teaching when I was on Baby Pips back in 2010. When I started out there and teaching on those threads that I vanquished it. Everything I put on there was mainly YouTube links. And when they pulled some shenanigans over there, accusing me of sock puppeting, do I look like somebody needs a sock puppet? For real? Come on. When I showed up, everybody showed up in that chat room. It was the highest viewed threads over there, and still is. But the liquidity below the previous day's low, and when we start getting in close proximity to it, okay, so what that means is we're watching price dropping down, and everything in price action was supporting the idea that it's going to keep going. How do I know that? How can you know that? How can you trust that it isn't going to reverse? Like you're trading inside this area here. Like what are you feeling while you're looking at the price lights? Like when you see that, what are you trusting? What are you leaning on? What's the logic that tells you this is going to keep dropping, ICT? Well, number one, it's trying to get down to the previous day's low where there's real orders resting below that. What kind of orders? Sell stops. Okay. So if I know that we're pretty uniform in the way we keep dropping, my eye goes to what I teach you. This candlestick right here is an order block. It's an up close candle. If I find that, and then every successive subsequent candle after that to the right as it's forming, as we move away from it, if it comes back up into this candlestick, is it able to overtake half of this candlestick? In other words, think about it like this. I'm teaching you order flow. This is real order flow. It has absolutely no requirements for level 2 data. People say, oh, show me your level 2 data. Fuck you and your gimmicks. That stuff doesn't work. you have faith in stuff that's literally nonsense. You don't need all that stuff, but it seems technical. You feel like you're a scientific trader when all that stuff's on your chart. And it's just clutter, and it's a myth. So here is half of that order block, okay? Did this candlestick or this candlestick come up and touch that halfway point, or which would be mean threshold? No. That's exactly what I want to see on an order block. Okay, the market trades lower. This candlestick trades up into this candlestick. So what does that make this? Propulsion block. So price should do what? It should trade away from that. Now, in this little area right here, we have a volume imbalance. That's what this order block delivers to. This candlestick, and this candlestick is working inside of this inefficiency where we had the body here. This candle's indecisive. It's just basically the open and close is the same price, and we have a high and a low. That's indecisive. Usually when you see an indecisive candle like that, you're building a volume imbalance. And the next candle, you'll see it's there. Boom. Find that in Steve Nielsen's book. But the rally back up just fills in that little void there. It's no bodies. It's absent of having any bodies. So the market will do patchwork. That's the technical term for it, by the way. I wasn't supposed to say that, but fuck it, it's a live stream. The algorithm is doing patchwork where it fills in these inefficiencies. Okay, so when it does that, then the market displaces and goes lower. At this moment, we can now see it goes back up, trades one more time. What is it digging into? the original order block. That is a reclaimed bearish order block. Why? Because we've already moved away from it and it's coming right back up into it here. It needs to show immediate response, drop lower. Does it? Yes, it does. And then we retrace back into this little area here, fair value gap, trades back up into it, hits it. Does that send price lower? Yes. Price displaces lower, takes out this low, trades up into this area here, matches the high here. Does it have any willingness to get up in this inefficiency? No. And then breaks lower right there. What I have right there is a market indicating in every shape, facet, or form that it's heavy. It means it's really, really heavy and it's going to be easy for it to fall. So what is it reaching for? Well, what are we close to? First order of business. Where are we opening up? Whenever you're sitting down into the trade, whether you're trading in the afternoon, whether you're trading in the morning, stop for a second. Let's just stop for a second. I got to take a second. What I'm teaching to you right now, okay, is so good. I really expect some kind of feedback today because this is some shit that this is worth way more money than I ever charged. And I really want you to think about it. When you're done with this lesson today, think about what you were introduced to and how you were taught. I taught you stop placement, how to manage a stop placement, how to read order flow, how to read price action, how to trust when the trade's going to keep going, how not to be afraid, how to enter these trades. I executed with these trades. I showed you it, I proved it to you, and I'm giving you all the details that I always keep to myself. But I'm always leaning to my sons and saying, this is what I'm doing. When they're sitting next to me, I'm telling them all these things as I'm talking out loud to them. It may not happen at the moment. Like I have to go back as it starts moving in my favor. And I'll say, the reason why I did that is I'm doing all this stuff here. But the heaviness in price is proven right here. So I'm confident that when we traded up into this area here, I'm not going to see the upper half of this close in. Upper half of this, watch. See that? Now, what have I been teaching in 2024 mentorship? PV arrays, the highest form, the highest order of order flow around them is when you're bearish, the upper half are not traded to. When they're bullish, the lower half are not traded to. That's the signature. That's the thing that you were never going to learn from me. That's one of the things, let's put it that way. But I was not going to teach that to paid mentorship students. They didn't need it. If they just used the lowest entry model, the bottom of the up candle, the low, just use that. When I felt a little bit more generous, I'd say, okay, go to the opening price. But these things were never supposed to be given to you. You have Caleb to thank for this. So when he gets out there and he starts jawboning, give him all that thank you and all that stuff, okay? Because it's him. That's why you're learning it. But the upper half here never trades to it there. So I'm getting short on this candlestick as it's already proven here, here, and here, and I need to be in. I need to be in on the move. So that's here. I don't trust that, I trust rather. I do trust that we're not going in the upper half of this range here. So this is what I'm visually seeing as a barrier. It's not going to go. Come on, Michael, get your eyes fixed here. Okay. It's not going to go up into this portion here. That's my belief. Why? Because everything all through here is indicating that it's heavy. We're real heavy. We couldn't even do institutional order flow entry drill here, and we had this big drop down. Now, when you're watching this might feel like, oh, well, it's been dropping. It's got to turn around. It's got to turn around. It keeps dropping. That's not what I'm thinking. Why? Why am I not thinking that? Because this is the previous day's low. It's indicating every way it can that is in a hurry to go down below the previous day's low. The previous day's low is like a honeypot. It literally is like a honeypot. It's always there every single day, previous day's high and previous day's low. If we open in the lower half of the previous day's range, whenever you're sitting down in front of your charts, whenever your operating hours are, and it opens up your time to trade, if you're in the lower half of the previous day's range, you should always look for some kind of return back to the previous day's low. That's simple market 101. Like it's a normal thing for that to happen. But when you try to learn, or if you learn from other people that don't have to trade, they don't know that. And they're looking for all these complicated indicator settings and all this confluence of all this dumb shit that's supposed to be overlaid on your chart that is a distraction. The only time I'm laying things over top of the chart is I want your eye to go to what it means to me when I'm watching price action. I am not wanting it to trade up here. Once it does all these things in here, I want to be in on the trade because I know it's getting ready to take off. The very next candle, what does it do? It opens and off to the races we go. And then we create what? Another opportunity for it to create a volume imbalance in here. So I'm expecting price to, it opens, it trades back up into this candlestick's range. So this big down close candle, it's not that big in terms of range, but in reference to, in relationship to all the previous candles' ranges size, it's a large candle. When this candle opens up here, I'm watching to see it dig back up into this candle. I am trusting that it's not going to go back under the upper half. So I just want to get in any portion of this lower part of this candlestick. Watch my fill. See it? Here's the low of that candle right there. It opens and it's digging into this portion of the range. I want to add to it. There you go. Selling more. And then I get another opportunity here. What's it digging into? The volume imbalance. I want to be filled there. As the candle's going up, I'm filled it right there, bang. And then what does the market do? Rolls over, energetically runs right below some random level, the previous day's low. And there it is. That's my fill. Look closely, folks. Look real close. This is the stuff I love. I love twisting a knife in the guts of the trolls. See that fill? That's one tick from the low. That's one tick, baby. You're talking to me like I don't know what I'm talking about in the comment section. But I'm proving to you that I am the #1 day trader on the fucking planet. Not YouTube, the planet. So I was making a reference over here because Patrick Wheeling, who I like, I genuinely do like him. I don't watch his stuff anymore. But he left a comment in this video saying that, so a breakout of a bull flag, or that was the NASDAQ trade, not this one. A breakout of a bull flag. Nice. So you've been watching my course. That was some funny shit. I shared that post with my private mentorship students. Anyway, I don't trade bull flags and bear flags. I fade them. And you look at the executions, I'm actually getting in at the levels that I teach that are absolutely not bear flags. And I don't use trendline breakouts. But it's fun. I love the banter back and forth. It's fun. Some people in the past have taken things too far and did terrible things. But I can have fun ribbing the next guy. And I can take a good ribbing too. It's fun. It makes it fun. I don't look at every little snide remark as a personal attack. It's fun. It's nice. It's like shop talk. And the people that worked on the floor, they did this shit all day long. And when you're in the locker room of the football players and baseball players, it's the same thing. It's just like when you're on a construction site, you're working. You're not going to be patty cakes and pats on the back all the time. You're going to mess with somebody because it's to get the juices flowing, to ruffle the feathers. It's fun. But tell me how that logic right there, I couldn't have made that any better. To get that exit price, I have to have the fill that the low of the candle forms. It's only one ticket. It's one tick difference. So anticipating this large range is down, incoming in the recording, is because we were approaching Monday's low, and it's going to dig aggressively and fast to get down there and get those orders. Because as it's going closer to that previous day's low, anyone that has their stop down there has the ability to do what? Quickly say, I'm getting out and I'm going to protect myself and remove the order. Think about it. You would probably do that same thing. You've probably done it many times. The few times you actually use a real stop loss, you start thinking, oh no, I got to get out of here. Let me take the stop off. But anyone that's short, they need those orders to be there to get out. So the first run into them is always going to be fast and sudden. Boom, sudden, real quick. Because they don't want to let them pull the order. And that's the signature that when I am saying I'm expecting speed, I want to see distance and speed, or I want to see the magnitude of the move to increase right here. I'm indicating that I'm expecting the pool of liquidity that's next in order of business going lower or higher. They're going to quickly run for that because they are not going to let them pull those orders. So as the algorithm delivers lower, 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 when it gets in a proximity of this low, it will naturally speed up. What does that mean? It does not matter how many people are coming in to buy it. And it doesn't matter how many people are selling short. That's why when you're watching price, it's here then it's here, and you think it's took a long time for that 1 minute candle to do all that. It's gapping down. It's very speedily dropping, and it keeps offering lower prices, and it gaps lower and lower and lower and lower. And inside these individual candles, look at them, study them. If you have access to do like a 1 second chart, 5 second chart, you'll see it's porous price action. It's not a smooth one single candlestick of movement going lower. It's jumping and skipping down there because it needs to get quickly down below that previous day's low. That's a mechanism that's coded inside of the algorithm, which cancels out all the tomfoolery bullshit that people say from myopic perspectives with their head up their ass and listen to people that don't know what the fuck they're talking about when they say it's buying and selling pressure that's moving price. That is absolutely not it, because it's spooling here. It's jumping and skipping real fast to get down to those orders. It doesn't need but one contract to book that price. One contract, that's all it's doing. It's going down here no matter how many people are buying and selling it. And the sooner you realize that, the easier this becomes. But you're arm wrestling me. You're arm wrestling me, think you're going to beat me into submission to your idea. Bullshit. It's never happening. You're not trading like me. You can't see these things before I can. You can't execute them like I can. But I'm going to believe your dumb shit, that I left that school of thought. I left that 30 years ago. Well, not technically 30 years ago. About 26 years ago. Think. If it's logic, that's sound, and it repeats, then you should be able to go in the charts and see it repeating. What is it doing over here? And once I say this, I'm done. I know I say that a lot, but I'm starving. I have hunger cramps right now. We got a low, a lower low, and digs in one more time. Right in here. So it's absorbed all of the liquidity below Monday's low. And then it rallies up. Liquidity. Easily digs into it. Into here. Easily above the relative equal highs. Then back down. When you start studying the price action like that, who's at the most vulnerable position right now? Who's making money? What are they targeting? And how can they upset them? And why would they, being upset, be profitable to some other entity out there? Okay. Well, going below Monday's low, buying up all the sell side with the expectation that you're going to run the highs over here. I don't even know I have this on here. This is obvious, right? I mean, this is so obvious, and that's what you need to be panning through your charts, Caleb. When you start seeing these things like this, these are the easy, low-hanging fruit objectives. They just cannot hide them from you. They are the setups that are just like 1 or 2 or 3 a week. They're the easy ones. You want to start looking for them. And then as you get better, you'll be able to work with smaller ranges and the things that you use when you're trading these bigger ones. You're just going to use it because it's fractal. You're going to use these on the smaller price runs. And you'll have sheer precision that evades everybody else. Everybody else. And you are thinking that this can't be done with a live account because somehow I'm afraid. I'm not afraid. I'm not afraid of that. Okay? Stuff repeats. But I cannot get out here and entice you with real money. I can't. I don't want to do that. I'm not going to do that. But when I'm executing in front of you, you're going to clearly see in the lower left-hand corner, it's going to say paper trading. And you're going to still see people out there saying, yeah, but it was paper trading. It was paper trading. And they're going to see these types of things deliver. And my question is, who can come out here and do the same thing? Explain beforehand, what it's going to do, why it's going to reach there. That your stop loss is where I'm going to be placing mine. The logic behind that will be repeating from the logic that's already been shared. Or if you think you know what I'm doing and you're doing it and you claim that you can do it with a live account and it's always a live account with you, please let me watch you. And I don't mean that to be condescending. I absolutely love watching traders. I love it. I don't care if they're using a different school of thought. I don't care. I can appreciate a trader. I've done this my entire life. And I just wish that there was more people out there willing to do it. Like, I want to see it. I love it. I think it's amazing. I'm not a sports fan. I'm a price fan. Like, I am a fan of price. And if other people engage it and they want to make it, if they want to share it with other people, oh man, I'd love to sit in and watch that. I would never talk smack about anybody that does that. I've never been in anybody's live stream ever. It's never happened where I've said that's bullshit. That's blah blah. If they said something about my own stuff, I'll correct them. But I have never talked down about anybody else's stuff because it's rude. If they're trading it and they're making money, who am I to say anything about that? I'm completely confident that I don't need to say anything about what they're doing because my stuff is superior. I don't need to go around and bark about it. But in my own content, I have every right to do that. And people come to my house and act like I shouldn't talk the way I talk. Like, you're a guest in my house. Don't tell me how I'm going to act. I'm going to act the way I want to act. Go somewhere else if you don't like what I'm teaching or talking about. But that's the business there. And I think that's enough for one day. It's going on 1 o'clock. I put some hours in with you today. I sure hope those payments come in for all this stuff. I have to get me a Tic Tac here and call it a day. So, if you liked what you've seen today, if you learned something today, give it a thumbs up. Even though it doesn't look like you can't do it, I see them. It's still there. So that's your little feedback. But I don't need to show it to everybody else. You can see everybody's, they usually thumb it up a lot. And we'll be back at it again tomorrow. I believe, let me make sure I say this right. Today's Tuesday, Wednesday. We might do a Wednesday afternoon session because I have plans on Thursday. So Thursday will be a definite early session. So we're definitely going to close shop Thursday at 10:30. And there's no chance of that going longer because I have a family member here that only has enough time to spend with me in the afternoon. So I have to make sure I get done, get cleaned up, have something to eat, and I can spend time with them and before they fly out. But so yeah, we'll do Wednesday afternoon. I'll start the stream tomorrow at 1:30 p.m. Eastern time. So I'll probably sit in tomorrow. Some of the people I like watching live stream, I'll be watching them while I have breakfast or whatnot. And then I'll start my stream at 1:30 tomorrow. And then we'll go probably till the close. I'll aim for the close unless it's something like, if I'm satisfied with tomorrow's discussion and we want to close earlier, or if I want to close earlier, then I'll do that. But just expect 1:30 tomorrow to 4 o'clock. So we'll worry about what price action is doing in the afternoon tomorrow. And then we'll meet up then. So 1:30 tomorrow. Until I talk to you next time. Be safe.